Ladies and gentlemen, please be seated. Our program is about to begin. Please welcome Semafor's Catherine Bilgore.
Good afternoon, everyone. Day 4, welcome. I'm Catherine Bilgore, Managing Director of Strategic Partnerships and Platforms globally here at Semafor. Very happy to be here this Thursday with all of you, and thank you all for joining us. For everyone or anyone who is not familiar yet with Semafor, hopefully you all are by this point in the week. Semafor launched just 3 years ago in a moment of unbelievable complexity, information overload, and eroding trust in the media. And our hope was to provide an antidote to that, particularly for the leaders navigating all of those dynamics by providing new intelligence for the new world economy. Semafor World Economy is the coming together and strongest reflection of the values that our organization was built on. It's a flagship convening here every April, and will be is a platform that is globally oriented, bringing together over 500 actually of CEOs from around the world and participants and principals from across 89 countries. We're so happy and excited that we were able to welcome such an incredible group here, including all of you in this audience. From an editorial perspective, we brought together our journalists from Asia, from Africa, from the Middle East, from the East Coast and the West Coast, here to provide conversations that offer insight and understanding and diversity in perspective that is so hard to come across nowadays. So this afternoon session is one that's especially fitting given that we have such an incredible group of leaders coming together with us. It is focusing on leadership in an uncertain world. So as leaders are navigating the uncertainty driven by geopolitical conflict, shifting power dynamics, and rapid technological change, we're going to explore the dynamics that these leaders and some of the antidotes they themselves are using in order to adapt and build resilient organizations amid constant disruption and growth. So I'd like to take a moment also to thank PwC, who worked with us to build this track and frankly, as a founding partner of Semafor World Economy. PwC has also been a partner of Semafor since we were 0 years old. So again, just a huge thanks to them for believing in us and what we're building here. We're very grateful for that support. Quick note on housekeeping before we begin. If you can just resist shifting in and out while an interview or a panel is on stage, just out of respect for our guests. But if you must do so, just do it during the transition. With that, let's get to the real news, and thank you again for being here.
Please welcome Bill Demchak of PNC, David Schwimmer of the London Stock Exchange, and Liz Hoffman of Semafor.
David, Bill, thank you both for coming. It's an interesting pairing. We've got a big U.S. domestic bank and a big global capital markets voice. So I think we should be able to triangulate what's going on in the world here a bit. Bill, let's start with you. You're talking to U.S. CEOs all the time. You've got a real-time snapshot into consumer household balances. Can you just, on a scale of 1 to 10, like how scared we should all be on the economic front right now?
First of all, remember I'm a banker, so like 90% of the stuff I worry about never actually comes to be, but that's my job. So it's actually really good, notwithstanding headlines and consumer confidence surveys. You look at consumer employment, consumer spending, the health of consumer balance sheets. Our deposits are growing on average per account. You wouldn't think that, but it's happening. Credit's really good. Corporates are expanding. So it's almost this weird vacuum. We just did earnings. If I got up and I went through all of our materials and you said, all right, tell me the mood of the world, it's not showing up in anything we see today. Of course, that's all subject to, and what could be tomorrow isn't what is happening right now in the moment. And we worry about the same thing everybody else is worried about, right? How long does the Middle East conflict drag out? How long is oil, at $100? How does that impact Asia, Europe? How does that bleed into the U.S.? On and on and on. None of those outcomes are good outcomes, but today you don't see it.
And what are you hearing on the global front?
You do see some of that now already. So in the U.S., there's a sense that if this war keeps going for a few more weeks or maybe longer, we might have a crisis. In Asia, we have a crisis. Yeah. And in Europe, it's getting closer. So I do see in a number of different areas, and as you know, I was in Asia earlier this week, a lot of things were going really well there. A lot of excitement, a lot of interest in new opportunities, Korea, Japan, et cetera, until this war kicked in. And it has created a real shudder through the economies, through the markets, and is having an impact on confidence and behavior already. And that's taking place in some countries, some markets that can afford to navigate through it for now. But in other countries, the Philippines, Sri Lanka, other places like that, there is real impact already in terms of having people work shorter days, work from home, et cetera. So it's an interesting mix in terms of how the U.S. is feeling about things right now in a little bit of its own, justifiably, in its own bubble, and what's going on elsewhere in the world.
Yeah, how do you reconcile, and I think about this every day, you look at the markets, the S&P is back in the green for the year. I realize it's not the only stock market in the world, but it's an important one. How do you reconcile that with, you see these sort of coming cliffs of supply? These are physical supply problems. These are not sort of paper things that you can financial engineer. Is this just complacency?
I think you could almost say that it is rational complacency, and that requires some explanation. And the reason I describe it that way is that if you go back for the last 25 years or so, in the U.S. markets, you have had, go back to the Greenspan put, if you will, you have had real learned behavior of buy the dip in this market and in this country. And it's been a good strategy. It's been a good approach. And there have been a number of government rescues. There has been central bank support. I think the question, and this is where you have to ask, does rational complacency tip over into irrational complacency? If you have stagflation, if you have rates going up and a lot higher energy costs, and that has a real impact on both consumer behavior and economic activity, then that's very hard for a central bank to fix. That's very hard for a government to fix. And there's been plenty of discussion this week or so over the 1970s and how does this compare to the 1970s? From 1973 to, after that oil shock, equity markets went down 40% over the next 2 years. Now this is not a prediction, but
I thought I was a negative guy. Can I mean, distinction. So if I look at what's happened in the U.S. today, to put a little sense behind why I think the stock market is where it is, corporate earnings remain really strong.
Absolutely.
They're driven by consumer expenditures. Consumers are employed. The whole notion, gas prices have gone up, but gas expenditures are 3% of the consumer wallet, right? So even in a K-shaped economy, consumers are, lower income consumers are spending, a concentrated amount right now on healthcare, housing, gas, food, staples. The wealth effect from the equity market keeps feeding itself, and we're spending in an economy that's creating corporate earnings that kind of sits where it is. Can it all fall? Yeah, but it's not irrational exuberance in the moment, right? It's this notion of if, in fact, oil's at $100 and the forward curve is 75 is wrong, how does that ultimately bleed through to a generic recession in the U.S.? Almost definitionally some small form of stagflation, just because inflation is going to hang around 3% or so, I think.
And I think that's the question. Yeah. In other words, if you look at the market performance today, it's looking at that forward curve for energy.
Yeah.
And it's thinking, okay, energy's going to be, Brent's going to be at 75 again in a few months.
By the way, we've run at 100 and been fine, right? We had a supply shock in the 70s. It isn't necessarily what's happening in the U.S. today. You can run the economy at 100. The real fear is if you're actually at 100 at the end of this year, then maybe it's a lot worse. Like to your point on Asia, if it's at 100 here, they're not getting any supply. Yeah.
So you think that sort of learned dependency, that people have essentially been bailed out, you haven't gone wrong buying the dip.
This is also in a current administration that is famously or notoriously sensitive to the markets and the equity markets in particular.
This is the Trump put replacing the Greenspan put.
And the question on that is, I think there's a market expectation that if things got really wobbly, Trump would fix it. The question is, when you have 20% of natural gas supplies knocked out, and some of that knocked out for 3 to 5 years, Trump could fix it. Doesn't quite work as well.
Yeah.
So those are some of the questions. I don't mean to be doom and gloom here. I don't want to replace you in that category. But I'm not, as I often say, I'm not in the prediction business, but I am in the scenario planning business. And I think right now the markets are pretty focused on a very rosy scenario, and there are some other scenarios out there.
Bill, let's talk about credit.
Yep.
Speaking of complacency, a couple of years there, 2021, 2022, maybe 23, seemed like people were writing loans with their eyes closed a little bit. What is your sense of sort of where we are in the credit market? And obviously there's a lot of talk about private credit.
Yeah.
You are not in that business. You're a bank.
But
what are we really talking about?
Hang on a second. So all banks do is private credit. We don't do SEC registered credit that trades on your exchanges. So private credit is a private credit agreement. What's going on in the market is levered speculative grade credit, not necessarily private credit. And inside of that space, 3 or 4 big instances of fraud, which tend to show up when things otherwise get tight in the market to begin with. If you just look at credit defaults, like throw out all the headlines and who's calling whom what and what's actually happening, default rates in the U.S. are increasing on speculative grade credit, and the amount of those loans who pay PIK interest, so not cash interest, they compound the coupon, is increasing at an increasing rate. And everybody assumes, probably correctly, that the actual ratings to begin with have been inflated relative to where they might have been 10 years ago. So we're going to have losses in private credit if the economy slows down. Jamie had said this on his earnings call, and he's exactly right. The losses will be greater than what we expected in prior cycles because collateral isn't as good. They've been inflated out of the gate. There's going to be loss in this space. The headlines in the moment, there's nothing catastrophic. There's nothing systemic. I don't think it's going to be. We have retail investors who are saying, you know what, this looks a little scary. I want out, and they're getting gated, and that makes it look like everything's terrible. The products were designed to gate retail investors. So I look at all this and say that, almost to your point, you were exactly right. People got a little crazy, 21, 22, 23. You got a lot of, bluntly young kids who've never had to work on a loan, investing capital. And doing so in a world where they've never really seen a default cycle because we haven't had one since, the financial crisis.
One thing we worry about with that kind of lending is where is it plugged into the broader financial system in a place that we're not seeing? And one option that I'd love your thoughts on is the banks that got pushed out of that business and went to these asset managers. They didn't go away. They went and lent to the asset managers, and so there's a bunch of debt that's on the back there.
Really different business. So we lend, primary credit, the original loan. In some instances to levered borrowers who we've known forever because they're going to do an acquisition or they're doing something, or we do it in asset-based form. As it got large and in credit quality that we didn't particularly like, it kind of went to institutional and banks pulled back. It's fine. Lower cost of capital outside, go ahead and do it. Those investors come to banks, just like they do for warehouse lines for mortgages or prime brokerage for their securities business. They come and they say, will you give us leverage on this big pool of loans? And banks do that. That leverage on those loans, we all sit, I can't speak for exactly what's on every bank's balance sheet, but I would tell you collectively, I'll be shocked if a bank loses $1 on their lending into BDCs or CLOs. Shocked. We sit at a low advance rate with covenants that allow us to liquidate the fund long before it ever comes up to us. They're all underwritten to a place. Maybe you take nothing away, take this away. You can basically shock the losses from the financial crisis 3x and assume the recovery rate is 50 cents on the dollar relative to the recovery rate then, and you still don't have losses in these senior facilities. So it's a totally separate question of, hey, should we be helping throw some gas through leverage on the fire of poorly underwritten credit? That's a societal issue. It's not a credit issue to us.
Okay. Switching gears, as you said, the panoply of unfolding crises is bad for Asia, bad for Europe. You sit in London, and we're 18 months out from the Draghi report. It's laid out a very bleak future for the European economy. I haven't seen a lot of progress on it. What is the best case you can make for Europe as an economic engine?
So there has been modest progress in a few areas. I think it's kind of interesting that I'm a New Yorker living in London, but speaking on behalf of European progress. There's been good progress in terms of, for example, the UK regulatory and listing regime, and it's made it much more flexible to raise capital in that environment. And there are lots of different things that have changed there, some of which is now being copied in New York. There's been some news this week about NASDAQ figuring out how to get some big IPO into an index more quickly.
Yes.
That's actually something that we have had in place with FTSE over in London for a while. So
the idea is to coax companies to go public by saying there will be this big pool of buyers faster than you think.
I think the way to think about it is that index capital is really important. In order to bring that index capital into the IPO capital raise, what you do is you basically fast track that. So historically, for indices, it would take, could take 6 to 12 months to get into an index after becoming public. What we did in London a while ago with FTSE is that if you were of a certain size to get into the FTSE 250, then you would move into the index within 5 days of the IPO. And what that means is that the index then those who follow the index become price takers in the IPO. So it's a way of bringing that capital into the initial public offering instead of having the index investors come into it months later. So a number of changes along those lines, really modernizing the capabilities. I think there's a broader issue here. One of the best things that's happening for Europe is the fact that the US is becoming a significant source of geopolitical risk in the world. And so we have seen a significant overallocation of capital to the US and a significant overexposure to the dollar over the last several years. This seems normal. It's something that we've all gotten used to. But if you go back 15 years ago, the U.S. capital markets were not. Today, the U.S. capital markets are 65 to of the global market cap. And the U.S., GDP as a percent of global GDP is more like 25 to 30%. So that's a significant disproportionate level there. And there's no reason why it has to stay that way. And we've seen these kinds of moves in allocation of capital to different markets over the years, and they do change. And just an extreme example, in the 1980s, Japan, the Japanese markets were 40% of global market cap. Today, they're about 5%. Now, again, this is not a parallel, and we're not saying that the US is going to drop that dramatically, but you are seeing a shift in allocation of capital from a significant, I'll say, overexposure to US capital markets and overexposure to the dollar to global investors recognizing it's not always going up, and allocating some of that capital into other markets, including in Asia, including in Europe as well. And part of that is also about reducing exposure to the dollar.
But to take that to its logical extreme, because I'm reminded occasionally that the Dutch guilder was once the reserve currency of the world. But what you hear a lot when you ask about is the dollar losing its reserve status is there's no replacement. Like if you tick through the obvious, I mean, I'd be curious your thoughts, like euro?
So the dollar is the reserve currency, and that's not going to go away anytime soon. However, you are seeing, and if you look at all the different metrics, whether it's in trade invoicing, or liabilities, or FX, all these different metrics, the dollar is as dominant as it has been for decades. In some areas, you're seeing a little bit of a shift. And so dollar reserves at central banks, that's coming down. Pricing, this is an interesting one in the current environment. We are seeing pricing of commodities in currencies other than the dollar.
Some tankers that have made it through the Strait of Hormuz, I believe, have been priced in yuan.
Yeah. And again, we're not here to have a history lesson on the 1970s, but the oil crisis and the creation of the petrodollar and the decision to price oil with the Saudis in dollars in the 70s led to significant recycling of petrodollars into the U.S. markets and the U.S. Treasury in particular, and was an important element of that kind of dollar supremacy, if you will. Given when you weaponize something, people will look for alternatives, and we're seeing Russian oil priced in other currencies. We're seeing Saudi thinking about pricing oil in another currency in particular. Again, early days, this is not any kind of statement that the dollar is not going to be the reserve currency anymore, because it is going to be the reserve currency for a while. But in these different areas, you can see things kind of chipping away at it.
Bill, you are stuck on the dollar. You are a domestic U.S. bank. Like, how do you think about? Is this a moment where you wake up and say, "Thank God I'm a domestic U.S. business. Like, I don't have to wake up every day thinking about Iran." It's pretty nice. Okay, but David just said that the U.S. has become a net exporter of geopolitical risk. Like, do you? I don't know.
All of that stuff. So it's really fun to pick on the U.S. at the moment, given some of the things we're doing globally, and point to weakness in dollar and point to part of the reason gold's rallying and all these other different things. We're still by far the most dynamic economy in the world. Period. End of story. No competitors. And so, we love to be here. Now, we can do massive harm to ourselves, as we've proven through history. But I'd much rather be here having that fight than I want to be anywhere else. And I get that it's really fun to throw rocks at the U.S. at the moment. And I'm not sure I can defend a lot against some of those rocks.
Okay.
But don't I think it's a big mistake to discount the power of our economy and what we can do.
The time we have left, I was out in your area in Pittsburgh, I think last summer, for the Trump had an AI summit out there, and you know there's places in the U.S.
Senator McCormick did.
Senator McCormick, yes. And there's places in the country that you see that are putting together capital, which you bring, power, technology. Sort of, curious where you see the opportunities. Where is PNC putting its balance sheet behind this stuff?
So energy, absolutely. Suppliers into data centers, so part of the value chain into data center builder, absolutely. I think the data center trade's gotten pretty hot. I think we have, by my simple math, we have a capacity to build data centers in about a third of the time it takes to build the energy to support them. So I think long term it's pretty exciting for our region. But remember, I'm a lender. We spend our lives earning a little bit of money, trying not to lose a lot. So that's different than the person who's going to bet their last dollar on Gen AI.
Well, we'll have to leave it there. We're out of time. Yep. Thank you both so much.
Thank you.
Thank you.
Please welcome Strauss Zelnick of Take-Two and Justin B. Smith of Semafor.
Good afternoon, everyone. Good afternoon, everyone. So I've spent all of my career, other than like a year, in the media business, and co-founder and CEO of Semafor now. But to interview Strauss Zelnick, if you're an operator in media, is an honor, because Strauss is one of those media executives that has had the Midas touch everywhere he's gone. I think he was president and chief operating officer of 20th Century Fox when he was 32, and then has just gone on and on and on, and just magic all along the way. He's now the chairman and CEO of Take-Two Interactive, which is one of the largest, if not the largest, video game companies in the world. Welcome, Strauss Zelnick.
Thank you. Thanks. Nice to be here.
He's also, I will disclose, he is also very smart because he's an investor in Semafor.
Yes. I am one of the first.
Well, first of all, you were always, I know that you're always the youngest CEO, the youngest, the fastest, most incredible. So tell us about just that experience of rising up so quickly in those across your career, and just continuing to rise and rise and rise and rise.
I'm not sure. There's nothing more pathetic than dining out at an old age on your youthful success. But it is kind of you to ask. Look, I was always passionate about the entertainment business, and I've been fortunate that I've been able to work in every entertainment business there is. I also was. I started my career as a very low-level executive at Columbia Pictures Television in the old days, and there was this thing called new media coming along, and new media, believe it or not, in those days was video cassette distribution and pay television, and all the traditional entertainment companies, which were populated by the cigar-smoking old pot-bellied white guy, knew they needed to be in the new media business but had no interest. So they always picked the lowest value executive at the company to be responsible for it, which was me. So I was able to be responsible for television distribution overseas and new media. And I became a student of what it meant to be in the new media business early in my career, and that served me really well.
It's been amazing. So across your incredible career, obviously the media industry itself has seen so many changes, all the way to till today. And so, what are you seeing now? Obviously, with AI coming, how do you look at this, the transformation, the changes today in 2026, and how do they mirror sort of broader changes in business or society or the economy?
So to limit it just to start, and we have like 11 minutes and 38 seconds left, so I'm going to be talking really quickly. But the electronic entertainment business started in 1895, and the entire history of that business has been the application of technology to entertainment. And what's happened over and over again is that new businesses have been created, and largely pre-existing businesses have still survived, largely, with very few exceptions. I used to say that the exception was vaudeville. Vaudeville really was wiped out by radio. But as it turns out, live entertainment today is bigger than it's ever been. And I would argue that a lot of live entertainment looks an awful lot like vaudeville. So what's going on today with AI and all of the collateral opportunities created by AI is that the media business will be once again supercharged and minimally informed by AI. And to talk specifically about our business, interactive entertainment, everything we create is created in computers using tools. So new tools are really, really exciting for our business. I think people spend too much time talking about the woe is me risk related to AI, and it is absolutely true that technology can be used for evil purposes. But the history of technology is, well, for better or for worse, it's going to come along anyhow. You might as well embrace it. And that, in my opinion, largely technology has been a great thing for humanity, and I don't think this will be any different. And on a more micro level, it undoubtedly will be a good thing for my business, undoubtedly.
So you've run networks, you've done a lot of M&A.
I can't keep a job.
Well, I think it's vertically ascendant is the way to describe it. So this year in particular, they've seen a lot of big M&A deals in entertainment. Do you see what's going on? Do you see something special here? What are the trends in M&A and in entertainment and media?
Any bankers here? Just checking. Okay, a few. Any people who buy companies here for a living? Yeah, more than a few. I do too. So there are two kinds of M&A, in my opinion. There's sort of defensive M&A, which is businesses are maturing, beginning to fail or have enormous challenges, and they look for cost reduction, and that drives people to team up because they figure, we can reduce costs. Paramount disclosed in their filings they expect to save $6 billion in their integration with Warner Brothers Discovery. It's a whole lot of money. We'll see if they can pull that off. So there's sort of defensive, maturation-driven M&A, and then there's aggressive, growth-driven M&A. So my company acquired a mobile company for $9.7 billion in 2022. We're a thriving business in the fastest-growing part of the entertainment business. And moreover, that business was in mobile, and the pre-existing company that I controlled, mobile gaming, was in consoles. So there weren't even too many efficiencies. There were some, but they were limited. So that was sort of growth-driven M&A. I think in the traditional backward-looking entertainment business, you will continue to see the consolidation that comes from, oh my God, like there's a hole in the boat. We need to patch the hole. We can maybe get another boat. But hopefully in businesses like mine, there will be some inorganic growth opportunities are driven by the fact that this is a really exciting business. And if you have a good balance sheet and you have a robust stock price, you have the opportunity to buy other companies and grow.
Yeah. Well, you're well known, particularly at Take-Two, for having sort of scaled this business through deeper investments in quality and creativity. Now that Take-Two has gotten so much bigger and is growing so rapidly, are you worried? Are you able to scale quality and creativity?
It's a great question because there does seem to be a sort of creative asymptote that any given creative organization can properly have. So when I was in the movie business a long time ago at Fox, one of our competitors, I won't say which, decided that, well, we have this fixed cost of distribution, which is quite high. So what we really should do is double production because then we would amortize the distribution costs over double the number of productions. So they went from about 25 pictures a year to about 50. What do you think happened? Their hit ratio got cut in half. They still had the same number of hits that they had when they had 25 pictures, except they paid for 50 of them. So it was a disaster. And of course, amortizing fixed overhead with negative margin is problematic. So the answer seemed to be in the major film studio business, you're kind of entitled to the number of hits that you can get with 25 at-bats. And a well-run major film studio has about a 30% hit ratio. Video game business is, on the console side, is a bit more friendly. So our hit ratio is about 85 to 90% on the console side, and we have
Is
not.
that everyone's or just yours?
A well-run video game company would be, in excess of 50%. We've been very fortunate. We have a higher hit ratio. And we have not reached the asymptote. We haven't reached the point where like, oh, you're making too many projects. But to your point.
So why not 85%? Why not scale? I mean, that's
exactly, I think, both the story I told about the movie business and I think the question you started with, which is, it just seems like the leadership team, good as I believe ours is, at any given company, there's just a limitation to your creativity. And at a certain point, you max out. So at a certain point, you have to say, okay, like we have done that. The good news is that Take-Two is not even close to that. So when we took over the company in 2007, it had $700 million in revenue, about a $700 million market cap. This current fiscal year, well, the year we just finished, I think our guidance was about $6.7 billion. We've told the market we're going to do much better in the current fiscal year, so you can figure out what that number looks like. So it's about a 10x, and our market cap is just knocking on the door of about $40 billion. But that makes us, 10% of the size of the biggest pure play entertainment company on earth, Netflix. So we still think we have a lot of opportunity.
So whether you scale it or not, how does AI impact quality and creativity?
So thank you for the prompt, because the three-part strategy of Take-Two is be the most creative, be the most innovative, be the most efficient. And we think AI informs all three. Briefly on creativity, anything that you can do that reduces mundane work means that our creators can do more exciting work. So when I started the video game business, which was, believe it or not, 1993, if you wanted to create a lawn, an artist had to create individual blades of grass. Otherwise, it looked like concrete. Today, this pre-AI, today if one of my artists, and I have many thousands of them, wants to create a lawn, they press the lawn button, and that populates a lawn. So just imagine AI, does that on steroids. So what does that mean? That does not mean that all my artists are now out of work. That's the mistake of AI.
Some of them might be out of work, right?
No, they won't be out of work. They'll be doing higher quality work. They don't care about lawns anymore. They care about, oh my God, this incredible creature.
What about the creature button?
The creature button is going to take data using AI, which is backward-looking, and we need to make creatures that are forward-looking to make hits. And so our creators have to do that. By the way, for those of you who think you're going to be unemployed by AI, two things. The history of technology is that technology creates productivity, productivity creates GDP, GDP creates more employment. So before the advent of technology, anyone here work at Goldman Sachs? I like to call out Goldman. Oh, that's unfortunate.
There's one here.
So
they're just shy about
90 years. Goldman Sachs is over 100 years old. 90 years ago, Goldman Sachs would be a room this size with a bunch of tables, with a bunch of men, all men, wearing green eye shades with pieces of paper and pencils doing calculations. Today, apparently, no one at Goldman does that anymore. Vastly more people are employed at Goldman Sachs, despite the fact that they're all using Excel, and in 2 minutes, they'll all be using AI if they aren't already. So that is the history. Remember the paperless office? Anyone know what year that was promulgated? I do. 1972. We were promised that because of digital technology, we'd have a paperless office. You can check, ask Perplexity. We use more paper in offices today than ever before. Just a fact, and we employ more people in offices. Finally, if AI were going to get rid of employment, the richest man on earth, Elon Musk, knows a little something about AI, last time I checked. He has unlimited financial resources, and he has unlimited human resources, and he has apparently an unlimited number of ideas. He also, he knows his way around AI. The man works 20 hours a day. Like, if AI were going to take anyone's job, wouldn't it take his job, like the richest guy on earth? Wouldn't that be like job number one for AI to take? Why is he so busy? And by the way, why am I working harder than ever, despite the fact that I've totally accepted AI into every part of my life?
Maybe AI has already taken him over. You just don't know.
Maybe Elon Musk is indeed a simulation. It's possible. I mean, in fairness, if you were going to choose a person who were a simulation, like, he would be my number one choice.
All right, we have just 2 minutes left, and I just wanted to really talk about something a little bit more personal, but also tied to business, which is the question of talent and mentorship. When I was running Bloomberg Media, one day Strauss-Zelnick was on our TV studios doing a TV hit, and I got all excited. Oh my God, Strauss-Zelnick is there! And I went up really shy. It was actually And I introduced myself, and he said, come have coffee with me. And I saw him for coffee, and 15 minutes into the conversation, he said, do you want to be mentored? And I said, sure. And next thing you know, he mentored me. Strauss, at any given time, I think in the last 10 years, mentors how many people?
A couple hundred people at any given time.
A couple of hundred people at any given time. And it's, in my experience, is that he didn't even know me. I mean, and it was just an act of generosity. And it was a serious mentorship that really helped me solve a lot lot of problems that I was facing.
We're not going to talk about it, but you had one problem.
That's off the record.
But here's the truth. Here's the truth. The reason that the advice helped is that you took the advice.
I did.
And then you said, oh, that makes sense. And then next time we met, you were like, I did that thing you suggested. Oh, my God, it worked. It was very gratifying.
It was advice about working for very powerful, wealthy people. Anyway, how do you think about talent, people, humans, compassion, leadership, mentorship? I mean, you're so unusual in how much you prioritize this. I think you're a unicorn to that effect. And, why do you do it, and how do you teach others to sort of understand it better?
I've always run creative businesses, and I am not the creator. And, so I had to acknowledge that, and I had no trouble acknowledging that up front. So I was never the person who shouldn't have read scripts who did. I didn't read scripts. I learned that I only had really one talent, which was, and I'm not sure it's a talent, which was identifying the talent in others. And I actually can tell the difference. And then I have some...
Was that an innate gift?
No, I had to develop it, actually. And then finding a way to encourage those people to work within my system, and then insist that they pursue their passions within the system, and then have a rational system underneath them that didn't torture them, and then to solve their problems, and then when they came up with something great, to have the best marketing team on earth and to have unlimited financial resources to support both the production and the marketing, and then to have more financial resources so that when we got it wrong, we could live to play another day, and then do that over and over and over and over again, which is why I've built entertainment companies over these years. So I didn't create anything, I didn't make any of the hits, but my enterprises in every business there is in entertainment have always had the highest hit ratios and the biggest stars, the biggest acts, and the biggest properties. And that's led by a person who has no talent. So I think for me it was more a recognition of my own flaws and limitations and a belief that I somehow could work with the best talent on earth and get them to make the biggest hits on earth.
And where do values fit into this equation?
So look, I'm loath to answer only because, I will obviously because I'm talking so much, but I'm loath to answer because there's so many different styles that can work. And my style is true to me. But the key thing about leadership, in my opinion, is that any number of other styles can work. So to torture Mr. Musk again, his style is completely different than mine. But you'd be hard-pressed to argue that it's not successful. My style is a style, you would note from this conversation, of listening with empathy, engaging, agreeing on a collective, powerful vision and mission for success, agreeing on the strategy, which I mentioned earlier, in our case, creativity, efficiency, innovation, agreeing on the culture, in our case, seek excellence in all things, work as a team, be kind, and then daily making decisions that are consistent with that view, even when it's inconvenient, and then doing it again and again and again, recognizing that strategy is one day a year and execution is 364. That's my approach, but it doesn't have to be your approach for you to be successful.
Well, you're being very humble. It's a very good approach.
Well, thanks.
So thank you so much to Strauss Zelnick.
Thanks for having me, Justin.
Thanks.
Please welcome from FGS Global, Alex Geiser and Ken Melman, and Semafor's Rachel Oppenheim.
Thank you so much. Thank you. So, Alex, you are CEO of FGS Global. It's the largest reputation management firm in the world. I know you've spent over 25 years advising boards, CEOs, and leaders on navigating the stakeholder economy. Thank you for being here.
Pleasure.
Ken, you are a partner at KKR. You also decided to invest $1.7 billion in this guy. You must trust him.
Very much so.
You've spent, Ken, nearly 2 decades shaping investment strategy at the intersection of geopolitics, public policy, sustainability. You also served as the chairman of the Republican National Committee and managed President Bush's 2004 re-election campaign. So thank you so much for being here, and I'm excited to dive in.
Thanks.
So just starting off, a question for you both. We lived through 9/11. We lived through 2008, through COVID. Lot on the crisis front, but this moment feels different. What do you believe makes this moment distinct, and what do you feel the most common leadership missteps really look like, given the terrain right now? Alex, I'll start with you.
Okay, easy. Listen, others have called it polycrisis, right? If you're a CEO today, it's your stakeholders going wild and telling you different things at the same time. It's your supply chains coming under strain. It's natural resources, your resources, capital, everything. You need to fight harder for everything. In short, it is more difficult to lead, right? And the missteps that we see, and obviously that we help clients try to mitigate, is you need to understand it's no longer the time for CEOs to play chess. It's full combat chess that's happening. Right? And you really need to understand that as a leader today, because if you don't, others will impact your business in a way that nobody's ever impacted your business.
I would add to that, I think the context is really important. So we're living in what I call and others have called a Gutenberg II moment. The combination of social media, the radical transparency associated with that, an algorithm that loves to weaponize villains, heroes, and dramas. And what that's done over the last number of years in this 21st century is I think it's compounded distrust. So the situation with respect to Iraq and the Iraq War created distrust in the military and in the intelligence sector. The great financial crisis created distrust in, obviously, the financial sector. COVID created distrust in the healthcare sector. And each of these aren't discrete, but they've compounded public distrust. So that we're now in a place where essentially what Martin Gurry, the author, calls the revolt of the public is in full spread. And as a result, if you're a leader of any organization, you have to appreciate what it means that everything that happens in your company, every mistake, every externality, every person that treats an employee the wrong way, you have to assume that's public. You also have to assume what often was your own most important IP, that you had exclusive access to information, is no longer the case. Those challenges, I think, require a CEO and a leadership team to think very differently about how they deal with transparency, how they earn trust, and to appreciate that the burden of proof is now on almost every institution in society. That's not something we had experienced before. And every time another crisis happens, it's not a crisis just in their sector. It's a crisis that will compound public distrust in a way that, in my opinion, makes all of us more subject to those challenges.
With that, Alex, you've made the argument that uncertainty actually creates a competitive advantage. But I think for most leaders here this week and many in this room, uncertainty actually feels like a reason to slow down and not speed up. How are you really supporting kind of the CEOs in your orbit as it relates to navigating those warring tensions between kind of speed and caution?
Well, Ken led there. If you think about it, for decades, CEOs were told, go with Michael Porter's 5 forces, right? Run the business, those are your controllables, et cetera. But it actually is, we're moving to a different world, and we are in a different world. And the way to lead now is, I would say, North Star management, right? If you're a CEO and any of your stakeholders, investors, boards, leadership team, customers, so on and so forth, are trying to figure out what your North Star is, where are you leading the organization to? Why is it compelling, secondly? And thirdly, why should they trust you that you're going to be able to get them there? Right? That's the big question. So that's the advice that I think everybody right now needs to follow, and it's the difference between effective leadership and failed leadership.
Can I add one thing to that?
Of course.
I think really important to that is recognizing the uncertainty in your system and creating essentially processes that avoid your responding to that uncertainty in challenging ways. So at KKR, one of the things we do is when it comes to investing, we have linear deployment. That prevents us during a bull market from investing too much and at a bear market from pulling back too much. So what's your business's equivalent of that? Second, scenario planning. You can't do that enough. If you anticipate the kind of risks you might face, and if you create essentially guardrails that say, I'm going to prevent myself from responding to uncertainty by leaning back or jumping in too much, you're in a much better place.
Ken, you have an unbelievable amount of expertise in the kind of political arena. You were just talking about this in terms of that linear strategy. M&A, capital deployment, looks very, very different in moments when regulatory frameworks are in flux, and also capital stability is not necessarily a given. Has anything changed in how you structure deals or you assess risk? What are the new rules that you're operating within?
Sure. So at KKR, we, as part of every investment we look at, we underwrite the risks you've described. So we underwrite 3 licenses to operate. Every company, in my opinion, has a regulatory license to operate. It has a geopolitical license to operate, including its supply chain, its operations, and its customers. And it has a social license to operate, what I call a loud but not proud. You also have to underwrite where you think the Fed's going to be, where do you think interest rates are likely to be as you figure out how to develop the capital structure for that company. And you also have to understand there is an unprecedented amount all over the world of opportunity to lean in. And that opportunity is around, if you think about the lesson that the world learned first from COVID, then learned from the Ukraine invasion by Russia, and more recently the Middle East. You know what it is? Something we call the security of everything. So people are in an unprecedented way focused on, they need more defense spending. They need to have critical industries like pharma operate in their country. For all those things to happen, firms like KKR and others need to partner with governments. So there's an unprecedented opportunity because of the policy and regulatory needs we see around the world around things like reshoring and the security of everything for private capital to do important work and to have good returns if you understand that regulatory environment and if you understand those 3 licenses to operate.
Let me build on that because there is one interesting layer there that is, I'd say in the last 3 years we've seen something we haven't seen for a very long time, that essentially the political strategy of major nations, major economies, is beginning to create opportunity on M&A. So all of a sudden deals...
Yeah, say more about that.
Right, all of a sudden deals that would have guaranteed failed with competition authorities, so on and so forth, and regulators, the sovereign, the leader, whoever it is, the president, the prime minister, chancellor, wherever you are, they actually might believe it's part of the national agenda and it might be of interest to do so. And then they will lean in. And that is something that we're seeing more actively today than at any point in time I can remember in the last quarter century.
I want to go a little bit deeper on the theme of trust. This is incredibly important to Semafor as a new news organization, really aspiring to break through to that new level. You're the largest reputation CEO in the world, and yet politicians today rank below ChatGPT in public trust. Business leaders are not doing much better than politicians as it relates to many of those trust metrics. At what point, in your view, does trust as a crisis actually become a real legitimacy crisis? And what can a leader do? How can they act if the institution that they are running has lost the benefit of the doubt? We started to touch on this a bit before, but would love to hear you expand on that here now.
Well, AI ranks beneath ICE, by the way. Also important with regards to trust scores.
Wow.
Here in the US. Listen, trust is everything. If you don't have trust, people aren't going to follow you. Take it just from any straight CEO agenda. If people don't trust that your North Star is compelling and worthy of support, you've already lost because people aren't going to support you. The second question is you need to ask yourself, and I think a lot of people, a lot of CEOs, a lot of leaders in the past, this trust thing was of interest but not of consequence. You really need to think about who are the stakeholders whose trust I need in order to get there. And the third question, and you need to take a look in the mirror, is why should they trust you? So what type of leader are you? And it matters. We've got so many CEOs who are like, I don't want to do it. I'm an introvert. I just want to lead the business. Well, newsflash, what Ken was saying earlier, you're leading a lot of resource, you're leading a lot of people, and it is of consequence, and it is connected to a larger game, I would say, in the larger game of society, right? We've traditionally had, if a family works and you have a healthy family, you've got a healthy community. You've got a healthy community, you've got a healthy nation. But the business community also needs to be healthy. And for that, we need trusted leaders.
Final question to end on. Ken, this one is for you. The conventional wisdom has been that companies should stay out of politics, focus on running the business. Given everything that you've described, do you believe that's still defensible advice?
I think it depends how one defines politics. I think what companies who are responsibly operating and want to maintain that trust need to do, in my opinion, is first, be honest about what are your potential negative externalities. Every industry, every company, every enterprise has potential negative externalities, and do you responsibly manage those? And second, are there ways you can make your company more profitable and more successful in ways that also benefit the public? Let me give you an example. So we're in the business at KKR, our private equity business, of buying and owning enterprises around the world. One of the challenges, if you ask any CEO they face today, is quit rate. Too many people quit. How do you get employees that are loyal? Something that we began more than a decade ago, and we now do across the board, is employees who work in our companies, not in the C-suite only, but across the entire business, own significant stock in the company, a meaningful position of stock. They also have a voice in how the company operates. They learn what EBITDA means, and they also help with financial literacy. And what that does is that produces a culture of ownership. We've now done this at 95 companies. There are 190,000 employees around the world that work at KKR companies that have billions of dollars in value in those companies. And they operate differently, and they behave differently. And by the way, when you do that, and if more companies do that around the world, you'll have less inequality, you'll have more engagement in the company, and you'll have more productivity. That's something we do because it makes sense from us from a bottom line perspective, but it produces other positive benefits. Think of what Walmart did about 20 years ago when they said, we're going to set standards for the supply chains. And when they did that, in many markets around the world, emerging markets and other places, those standards, labor standards, environmental standards, improved. So companies have a way to actually engage that meaningfully solves problems. What they shouldn't do is virtue signaling, and because it's inauthentic and it's not real. I remember a few years ago, there were a bunch of people in New York, I live in New York, who all wanted to sign a letter saying this new Georgia voter ID law is very problematic and is unfair. But in fact, the Georgia law was more permissible than the New York law. And so people from New York telling other people what to do when in their own state they don't do it is called virtue signaling. People don't like that, but they do like if you manage your negative externalities, and they do like if you look for ways that your enterprise can do good for your shareholders and do well for society.
Well, thank you for the insights on trust, uncertainty, equity, combat chess. I'm going to take that one away. Thank you both for your time.
Thank you.
Thank you.
Please welcome Raj Ganguly of B Capital, Ben Lamb of Colossal Biosciences, and Reid Albergotti of Semafor.
All right. Ben, Raj, thank you for coming. Great to see you. Good to see you. Thank you all for being here. This is going to be a good one. You should stay if you like Jurassic Park.
Or investing in saving the world.
Or investing to save the world. Ben, we've all seen Jurassic Park, I think, and we know how it ended.
I love how this is how it's starting, but yeah.
What's the appeal of bringing animals back from extinction?
Well, I think that ultimately, I think there's kind of two things if you look at it, both from an impact perspective and an inspiration perspective. I think that we are in a global crisis where we're going to lose up to 50% of all biodiversity in the next 25 years, and we need new tools and technologies because modern conservation doesn't work at the speed at which we're eradicating species. So I think that we have to innovate there, right? And how do you innovate there in an area that is typically undercapitalized and people haven't put the real value on biodiversity as they should? And so what's great about de-extinction is it gets the inspiration going. It gets kids excited, it gets parents and teachers excited, right? Like we have 500 billion media impressions because of objectively a little cute mouse and the direwolves, right? And I think that if you continue to use that momentum to build a system model for de-extinction, you can also inspire the next generation while then subsidizing all the technologies for conservation. So I don't think Jurassic Park had a conservation bent to it, unless I missed it. I think that's how we look at it, and I'm sure the film looks at it slightly different.
That's true. Raj, you're not an investor in Colossus or in any Jurassic Park related companies, to my knowledge, but you are invested in biosciences, AI, and drug discovery, things like that. So I'm just curious, like, how bullish are you on the use of AI and this kind of stuff we're hearing about right now?
Yeah, I mean, I think that AI really has the power to transform and bring back not only species, but I think it has the power to have human beings stop doing things that we shouldn't be doing. We started investing years ago in robotics, and our first investment was a very simple robot that sands airplane wings. And sanding airplane wings is incredibly carcinogenic. Human beings shouldn't do it. When you sand fiberglass, that fiberglass gets through almost any filter. And that was one of our early investments in robotics. We've continued to invest. We're on our 7th robotics company. And we truly believe that it's both about things like conservation, treating new diseases that we've never been able to treat before, but also about freeing up human beings to do what we were really meant to do, because there's a lot of tasks that we do that we weren't meant to do. And I think for a long time I've said we're in a 20-year AI super cycle. I think it's a 10-year AI super cycle, and it's going to happen much faster than a lot of people think.
Oh, that's interesting. And yeah, one of those robotics companies, I was going to ask you about Aptronic. They're doing humanoid robots. What's the timeline on humanoids? When are we going to have these things like in the home, for instance?
So Aptronic's
or in the lab.
Yeah, Aptronic's an amazing company.
Or in the lab.
They actually built the first Tesla humanoid robot. They did it under contract for Tesla. We found these guys and we said, it's incredible what they were doing for NASA, what they were doing for Tesla. We funded them. They've become quite a big company. If you go to Mercedes-Benz factories today, you'll see Aptronic robots walking around. So I think the time is now. We still have to figure out the human-to-robot interaction. You guys have seen some of the videos of a robot in a restaurant going crazy and people trying to restrain it. A Aptronic humanoid robot can lift a car. Us versus the robot wouldn't end well. So we have to figure out exactly how to make sure the interactions between humanoid robots and us works, but the robots they're coming this year.
Yeah, they had the Olaf robot at GTC, and I watched it fall over as well. So that was fun.
You asked me the Jurassic Park question, and his robot saved the world. No Terminator questions. So.
Okay, no Terminator. Well, tracks. We can go there if you want. I think one thing I did want to ask you about. So you partnered with Eduardo Saverin, who's the co-founder of Facebook. How involved is he in now it's Meta, I don't know what you say now because it's in the past, but how involved is he in the day-to-day? Because obviously he's, many, many billions now. He's, probably could do anything he wants. Is he out there, is he rolling up his sleeves investing?
Yeah, so Eduardo is so the two of us run the firm. We were investing together before we started the firm. We decided we wanted to institutionalize about a decade ago, so we're 10 years old this year. And we're really thinking about what's the next 10 years look like. But Eduardo has he is our chief AI officer. And he, over the last couple of years, has had a deep belief that we all fundamentally need to change the way we think about AI. We have to stop thinking about AI to do things faster, and we just have to start with an AI-first mentality, even if it takes a little bit longer the first time. That by training the AI, it's not really about the latest model. I mean, it's great that there's a lot of hype about the 2 new models that have come out. It's really about contextualization, that you can use an older model with the right contextualization. It can really still do tasks incredibly well. And he's really been our chief visionary on this. We've built our own set of internal AI tools. We've replaced almost everything. Can't seem to replace email. Email is like the toughest thing. Like we've all had email for 50 years, but he has replaced our ERP, our CRM, our everything that we do. We have something internally called the Beehive. As if he was here, he'd say my only contribution has been naming it. He built it, but I named it. He likes to take credit for the Facebook F, but that was a long time ago. And so the Beehive is our own internal data system. The Hive is a ERP, CRM. All of our data exists in it. I wouldn't say all of our data, 10% of our data, 90% of data is unstructured and not captured. We're working on that, on fixing that, but the Bee is an agentic AI that works alongside of you. This year, it's transitioning from being agentic AI to an AI coworker, and it's really incredible what he and our AI team have built. And I always, joke and say this, that his vision is to get the firm back to AI and just him and me, and he always says, no, just him and the AI. So I know his goal is to replace me too.
With a robot. So Ben, your ultimate goal is the woolly mammoth, right? But you've sort of made stops along the way. You've done a dire wolf. What's the next? What's the next one?
Yeah, we had three pretty consistent questions of when are we going to have X?
Yeah.
Can you make a dinosaur, or a Pikachu, which is a rising question set, which is interesting from what we learned about our society. We learn a lot from the feedback we get with Colossal. And then the third is what's next, right? So everyone wants to know what's next, when are we going to have a dinosaur or Pikachu, and then when we're going to have what. So we're on track for 2028 for our mammoth calves. We're in the editing phase. We feel pretty excited, pretty bullish on that, which is exciting. We have a couple updates we'll share this year around dodo. We will not have a dodo this year, but I think we will continue to share on our flagship species that we will have additional updates coming. I think it's highly likely we could see another woolly mouse-like moment. We did the woolly mouse I don't know if you saw the woolly mouse. It's objectively pretty cute. And we did it as a proof of technology on just the editing capabilities that we had, the health to the animals, and predicting the phenotypes or physical attributes, and testing what we're doing on the mammoth. So I think it's highly likely we could see another proof of technology in the near future. Mm-hmm. We just spun out another company, so I doubt we'll announce another company this year. I don't think we'll announce another species this year, but I think there's a couple other new projects that may make their way to the public in the back half.
Well, I do. Maybe this is a less obvious question, but I mean, there was a little bit of a backlash from certain corners of the scientific community when you.
I love that you phrase it that way, because sometimes when we get the same question over and over again, they say scientists think, and I was like, well, we have 17 universities, 95 scientific advisors, we fund 80 postdocs, and I employ 260 Nobel scientists, right? So
it's a bit of a philosophical question, right? Because it's like what you did is you modified the genes of
right.
a wolf that we have today to make it more like a dire wolf. It's not like in Jurassic Park where they just you just fill in some frog DNA here and there. So what's the I just want to know your response to that.
So
like,
I'm a big force for the trees guys, right? And so my thing is everything we do with Colossal, every decision we make, we try to have three core tenets. It's value creation for our shareholders, it's impact for the world, and it's inspiration for kids, right? And 30% of our investors, which I'm really proud of, came from their kids. So 30% of people in this room's kids told people like you, and then they invested, right? Which is pretty great for us. And so I think we're doing a lot of things more right than wrong. But I'm a big, if people want to say our woolly mammoths are woolly mammoths, that's amazing. If people want to say our woolly mammoths are cold tolerant Asian elephants with 200 edits from 104 different mammoth genomes over 1.3 million years of persistent time into mammoth alleles, they can say that too. And I think sometimes that small subset of people that it's about 2.5% is what we track on it, that wants to have that debate. We're like, you have every right to take that position. But they probably will be the same people that will tell you that Jurassic Park is not about dinosaurs. It's either about hubris or frog birds, right? And that's just dumb. You tell your kids the movie's about dinosaurs. If you don't, you're missing the entire thing.
Right. How are you going to make money once you do this?
So a couple ways, right? So one is we have a couple of internal ways, but when you think about Colossal, you kind of have to think about it in two ways. Most people think of colossal as like, oh, those are the mammoth guys, or the de-extinction people, or that's Jurassic Park, right? But really, de-extinction and species preservation go hand in hand, and it's really an application. I come from software, so I kind of think like software. It's really a application layer, right? If you look underneath at kind of the core platform, Colossal's built, arguably the #1 synthetic biology system in the world, right? While most people are doing like 2 edits at like 15% efficiency, we're doing 200 edits at 90% efficiency, right? And we've had to solve so many parts of the process. We don't talk about AI much because we do use it quite I feel like we live in this world where people are like, you can't eat this cereal without my AI-assisted spoon. And so we don't oversell AI. We don't even talk about it at Colossal. But we're doing things like ancestral state reconstructions and predictive modeling around evolution. And so with all of that, that kind of gets us to our end state. But that same platform that can make you mammoths or dodos or direwolves or whatever, or objectively cute woolly mice, can also make a drought-resistant cattle or super plants or microbes that eat plastics, right? And so we're finding that the option value for spinning out and licensing the technology is quite high. Our most recent spin out just raised capital north of $2 billion, which is exciting since it's 9 months old, called Astromech. And then in addition to that, we're now working with governments because governments have not historically understood the value of their biodiversity or ecosystems. And so we're now helping them on their strategies of how to use these technologies, look at the cost-benefit analysis, right? Like how can you use cloning and synthetic biology and things like cryopreservation to actually increase healthy populations of animals and do it in a fraction of the time and a fraction of the money that traditional conservation doesn't work.
Yeah. It's interesting. And Raj, we were talking backstage a little bit about this. You have this sort of vision for the next phase of B Capital. Can you go into that a little bit? I thought it was really interesting.
Yeah, that's great. And listen, I think ultimately what's happening with AI is it's really about how you put it to use. Like, I'm so glad that it's someone like Ben with the values that he and Colossal have in terms of what they're doing with the power of AI. And our fundamental belief at B Capital has been that we think that financial services is an incredibly important industry. The allocation of capital into innovation is fundamentally, and that decision of where to put that capital is a huge driver of what happens in the future. And so as we scale and grow in the next decade, we have a fundamental thesis around how investment firms and asset management firms really need to transform and become AI first. I think you've seen a little bit of this with the Janus takeover, where our friends at General Catalyst were involved with Nelson Peltz. Yeah. Mm-hmm. I think we have a larger thesis that there is a lot of investment firms out there that probably don't realize that in the next few years that you've got to be able to fundamentally transform your business using AI. And so we're now looking at how can we buy asset management firms and investment firms and transform them using the tools that we've built for our own firm. And we fundamentally believe that there will be the opportunity to build an AI-first $1 trillion+ asset management firm in the next 3 to 5 years. And we'd like to be able to do that if we can.
I think that's super important. I think it's great. Because I think you have to have money at that scale to invest in the moonshot things that are going to really move humanity forward, right? We can't just have SaaS 7.0 or whatever.
Yeah, the 20 years of SaaS was great, being able to invest small amounts of money in super capital efficient businesses. The next decade, the next 10 to 20 years, is going to be much more capital intensive between power and just the compute. And so we want to have the scale to back companies that are really doing moonshots and be able to back them for many, many years.
I mean, Ben, you are doing a moonshot. But what's just really quick, I'd love to know, like, if you, let's say, money were no object, you could just snap your fingers and do anything. Is there a moonshot that we should do, that someone should do?
That we're not working on?
Yeah.
I would, so I'm really interested in underwater cities. This is I just am. And I think that there's so much interest. Like, if you look at like ocean life and ocean temperatures, especially in a rising climate world, that that like 90% of sea life is between like 30 and 60 feet. And so I think that if you do that, that also prepares you more. It's much easier to sink ship and put it in space with rad hardening and heat and cold inversion. So I would focus on building the right type of autonomous infrastructures to expand life in kind of that temperate climate zone of 30 to 60 feet. I think it'll make us more ocean aware. I think it'll make us focus on corals, and I think that will make us even more prepared for space versus sending stuff up that's either doesn't work or is fake.
I cannot wait for the first Semafor event under the sea. In the,
We're not doing
that. It's all the time we have, though. Thank you.
Thanks. I appreciate it.
Thanks a lot. Thanks, man.
Please welcome Jim Esposito of Citadel Securities and Liz Hoffman of Semafor.
Hi, Jim.
Liz.
Hi, everyone. Thank you for coming. So Citadel Securities, a lot of people know Citadel, the hedge fund, but Citadel Securities is one of the largest market makers in the world. You buy and sell a lot of things, a lot of stocks, a lot of treasuries all around the world. So let's start with a market check. We're 7 weeks into a big global conflagration. What are you seeing from around the world? Where is money coming out of? Where is it going into? What's liquidity looking like? Scale of 1 to 10, how scared should we be on the market side?
Okay, thanks. Let's get there. First, let me put Citadel Securities in context, because as you suggested, I think many people in the crowd are familiar with Citadel, the hedge fund. Citadel Securities is a completely separate and distinct company. And the way you should think about Citadel Securities, we are very much a next generation technology-driven market maker. We service both institutional and retail clients around the globe. And we are one of the biggest traders, executors of global equity and fixed income securities. And I just want to contrast what we're up to versus some of the big bank peers that we compete against. And I'll just give you a couple of high-level statistics. On any given day, Citadel Securities accounts for about 25% of daily US equity volumes. We are 35 to 40% of US equity retail and option volumes. We're a third of listed option volumes in this country. We send out close to 40 billion option quotes per day. And so we're a company that's already extracted a technology dividend. And against all of that, we only have 1,900 professionals. And so a very different model than what the banks are employing. The other thing that I'd mention, a little bit of a superpower of Citadel Securities, of our 1,900 professionals, 300 of them possess a PhD. We really sit at the intersection where technology generally, but AI, machine learning, predictive analytical tools meet traditional Wall Street. It is our 300 PhDs who come to us from the very best undergraduate universities, PhD programs. We're truly attracting the best and the brightest minds who come to Citadel Securities to solve the most complex problems, financial problems in the world. And so that operational scale and efficiency, having levered technology, combined with this quantitative researching talent that we have, I think has led to our commercial success. Now, Liz, to your question, we're executing more equity volume than anyone else. We're growing rapidly in fixed income. What are we seeing in our platform that might inform your market view? I guess the thing that I would really say is the thing that keeps me up at night, I worry about investor complacency. When you look around the globe, and here you'd have to really say positive things about What has transpired since the global financial crisis, policymakers, central bankers, regulators, they didn't just support global financial markets. If we're speaking bluntly, they saved financial markets. But we've now had almost 20 years of extraordinary, abnormal, accommodative monetary and fiscal stimulus and accommodation that's pumped into global markets an inordinate amount of liquidity that's still swashing around the global financial system. If you graduated college in 2008 and went to Wall Street to be a trader, went to an asset manager to be a portfolio manager, you'd now be 40 years old. We've raised a generation of investor that really never learned the price of being wrong. Every time there's a dip in the market, whether it's a retail investor, institutional investor, rightly so, they buy the dip, and they've been proved right. I worry about a breakdown in discipline and complacency. That's nobody's fault, but I think that's the generation of investor that we would have raised over the last period of time. Now, this is the punchline, and this is why it matters. I might suggest those same policymakers, central bankers that did so much to save the financial system, they have far fewer degrees of freedom at their disposal going forward. Inflation already has reared its ugly head. We went from, in continental Europe, in the UK, pricing in multiple rate cuts to now pricing in multiple rate hikes. I worry now, as we get more stresses and strains, potential dislocations for all of the geopolitical headwinds that we're facing, we don't have the same tools at our disposal. Bottom line is that buy the dip mentality, I'm not foreshadowing a market correction or crash, but at some point, there's going to be a clash there.
Helps explain the gap between sort of how the world feels and what we're seeing in markets. Fair to say that Citadel has a bunch of AI bots like running around doing a bunch of trading?
Yes, we do. Look, I think it's important. I referenced, some of the founding principles of Citadel. We've been at this for more than 20 years. We were a company founded on the principles that leveraging technology to service clients, to execute the things that we want to do is a really powerful force. We were using large language models, machine learning techniques before most people either knew or were talking about those things. So that's infused into our culture. Now, at the heart of your question, let me be clear, we're absolutely making a lot of progress around agentic AI. Appreciating, many people at the conference are corporate CEOs, and I'm in financial services and a market-making business. But to make this a broader point, I would suggest in business, speed matters, and speed matters more than it ever has before. And so what I'm seeing with agentic AI, we're just completing tasks, traditional things that we needed to do faster than we ever have before. A simple example of that is you can imagine at Citadel Securities, we run a couple of very large risk models that really manage all of that flow, equity and fixed income that's coming through our platform on any given day. Pre-agentic AI, we would look to re-underwrite, tweak, rebuild those models at best 3 to 4 times a year. Every time we were able to do that, we would provide a better client experience, and that would fall to our bottom line, so we would make more money. Given the advent of increased computing power, agentic AI tools, just technology scaling more efficiently than ever before, we're able to re-underwrite those same models, not 3 to 4 times a year, now order of magnitude about 12 times per year. And so we're just getting faster, more efficient, and it's having a big impact on our client franchise, and it's having a big impact on our bottom line.
When you think about the value that's created there, and this is a question we've been asking executives in all different industries, AI is obviously going to create a lot of value. How does it get shared? How do you think about what falls to the bottom line at Citadel? What's lower execution costs for clients? Sort of what kind of gets thrown back into the ecosystem?
Well, look, I would suggest we live in a hyper-competitive market for the services that we provide. And so clients interact with us, certainly not solely based on best price, but that's a part of the experience. And so the more efficient we get, the better service we can provide. If I were to show you a graph of what's happened to retail execution costs in this country over a 20-year period, I mean, it has fallen exponentially over the previous 2 decades. A lot of that, now we're not the only person that's had an impact on that, but the US retail investor trades pretty much for free, very close to free. And so similarly, as we've grown and had a bigger impact in the institutional market, not just in equities, but we're now top 3 player in US Treasuries, top 3 player in dollar interest rate swaps, investment grade credit. We're providing more liquidity at more attractive prices for our clients. So I definitely think our clients have been a beneficiary of that. Last thing I'll say about AI, when you think about what we're building towards, and this is the journey we as a company are on, and you think about the impact that Amazon had on the consumer, but specifically in e-commerce, we're absolutely looking to build an identical type ecosystem where our clients live and consume Citadel Securities content, might be data sets. They might want to run their own analytical models on our platform, back test, simulate, stress test different trades, click to get an indication on price from us. You like the price, click to trade with Citadel Securities. This seamless front-to-back execution system. Many of us live in that Amazon ecosystem. It gets better and better the more you use it. It's predictive in its nature. It knows what I need before I need it or buy it. I think we're creating a parallel universe for market making. AI is a part of that. Our ability to scale technology is a part of that. And so it's a very different business model than some of the more traditional players.
Is this, we see you bought a 10-year treasury, we think you might like a Eurobond? Is that where this ends?
It rhymes with that.
In time we have left, I want to ask you about prediction markets, and not the sort of long tail of nonsensical and possibly illegal bets, but the sort of rise of real institutional risk pools. The thing that is missing there is institutional liquidity. You know, there was an interesting market last year about what the Supreme Court would or wouldn't do on tariffs. You could see a big retailer being interested in playing in that, but it wasn't deep enough. And I wonder, it seems like an obvious place for someone like Citadel Securities to come in and say, we'll provide a bunch of liquidity to this market.
Okay, let's start with the facts. We are currently not involved whatsoever in event contracts, predictive markets, the way you describe them. But we're absolutely keeping an eye on developments in the market. I came across my good friend Tariq Mansour, founder of Kalshi, here at the conference and spent time with him. And so we've built a good relationship, and I'm following his and other business models quite closely at the moment. A couple things I'd say. There's 2 parts to their business models. There's sports betting and event contracts. We're not looking at sports at the moment at all. I don't see us entering that market. Event contracts is interesting to us. Look, we're in the client facilitation business. You mentioned institutions, but we execute and support clients through 2 distinct channels, retail and institutions. When you think about Robinhood and Charles Schwab and all the global retail providers, if retail clients are going to get active through those platforms trading event contracts, good chance that will pull us in because we have to be a good partner to Charles Schwab and Robinhood. So that's one reason that we're keeping an eye on it. Specific to your question, Liz, with institutions, I'll be clear. I think there's a sound industrial logic, real reasons institutional clients would want to use these contracts to hedge various risks. Now, you look around this country, we're about 200 days out from midterm elections. That's going to be a seismic event. That's going to fire the gun for all of us getting very focused on what comes next in the presidential election. I would put forward that's going to be some of the biggest risks to investors' portfolios that they're going to have to grapple with. Having a clean and distinct way to hedge certain risks, I think there's a good use case and industrial logic to it. So whether it's our retail involvement or servicing institutions, we're not there yet. There's not that much liquidity, but will this market ramp and scale? I think it's likely. And as it does, will we continue to look at it and potentially get involved? Certainly possible.
We will have you back next year to talk about all of this. Thank you so much, Jim.
Thanks,
this was really fun.
Please welcome Michelle Horton of PwC US and Rachel Oppenheim of Semafor.
Thank you. Michelle, just to give the audience a little bit of context about who you are and what you do, your role today is risk and regulatory principal at PwC. So you're bringing over 25 years of experience in solving complex challenges across a ton of different industries, healthcare and pharma, consumer clients. So as a relationship partner, you're advising boards, executive teams on governance, on risk management, and I know that you specialize in helping organizations navigate global environmental shifts. So this must be an unbelievably busy period in your line of work.
Yes.
So just to start off with our first question, in your view, are we navigating a temporary phase of disruption, or do you feel that we're heading into like perhaps a fundamentally new or more permanent operating environment?
It's a great question. And first of all, thank you, Rachel, and thank you, everyone, for having me here. It's been a great week, and it's been wonderful to hear everyone's perspective on the world we're living in right now and just the optimism, actually. It's been wonderful. So I do believe that we are not necessarily in a cycle of disruption. I think there's not a finish line. I think it's not going to end anytime soon. Our recent survey that we did of C-suite executives told us that the executives are finding their footing. So they're feeling better than they did a year ago. And in fact, 90% of executives said that they believe that their company is stronger than it was 2 years ago, which is outstanding and maybe a little bit surprising as well.
Hard to believe.
Yeah, hard to believe. But 67% still feel like they're not making decisions fast enough. So there's a, opportunity and a bit of a disconnect there as well. But we're seeing that these companies also feel like they are ahead of their competition. So, the message is a little bit choppy, but they've moved really from paralysis to acceptance. The operating environment's tricky, so it means that these executives are also going to need to think about how to do things a bit differently.
So you've shared a little bit about the sentiment, how executives feel. Would you be able to share a little bit more with us about how CEOs and leaders of companies are practically changing strategy for the organization or practically changing from a decision-making perspective? Yeah.
It's a great point, and one that I feel like I've heard so many stories this week that I could now cite, without attribution. But really, we are seeing that 87% of executives see disruption as an opportunity, which is, again, fantastic. However, we also heard in our survey that the areas in which executives are investing are very much the same. So there seems to be a bit of comfort in the commons. So everyone's making AI investments. We've been talking a lot about that this week. Folks are really focused on proactive risk management and, last but not least, trade strategy adjustments. So a lot of the same things, but it raises the question, if everyone is doing the same thing,
what's the advantage?
Right. Who's getting ahead? The other point that I would say was interesting in the survey is that the majority of executives go first to a defensive move
versus an offensive move. And there really is an opportunity in the offensive moves. So that's a lot of what we're seeing and where we think we should play.
That was a subject that I wanted to get into a little bit more with you. What do you think is separating companies from the kind of those who are playing offense versus defense, those who are really capable of expanding versus those who are in retreat? What is separating those organizations?
I think one thing is short-term versus long-term thinking. I think that the markets today sometimes tend to reward short-term moves. And so I do believe that thinking longer term is something that those that are getting ahead are doing. We've heard some stories this week about companies that have really taken advantage of different strategies, doubled down in areas maybe others wouldn't. I have a client that I've worked with that's a medical technology company that, much like many of you in this room, have really been weighing their business in China and trying to decide what do they do, especially with, yes, the IP concerns, but then also the geopolitical, state of the relationship there. They've decided, they are a bit more a risk-taking company, they've decided to double down and take advantage of the near-term revenue and volume growth. And at a later time, when the signals start to tell them that they need to pull out, they'll do that.
We are here at Semafor World Economy kind of as a news organization. And I think in a lot of ways, headlines and noise can drive sentiment and can drive how people feel and act. As it relates to those risks that you're looking at, which are the ones that you sit down with your CEOs and your partners and you say, actually, these are risks that we are overestimating, these are risks that we are underestimating? Can you kind of educate us a little bit about how you deliver that advice and what you're looking at there?
It's kind of a simple question for a really nuanced answer. And I would say after spending my whole career has been in risk management, it's what I've done. I would say we are seeing some of the same risks hit the top of everyone's risk list. Cyber, no surprise there. Macro volatility, geopolitical.
Big news on that this week.
Yes, absolutely. And I mean, I would also say that regulatory complexity, just the navigating all of the different patchwork of regulations here in the US, but then also globally. I think the actual biggest risk is not seeing these risks as compounding and looking at them in silos. And I think that that's what we have tended to do historically because we weren't able to really fully model out how these risks interplay and what the true effect could be. I think there's a lot of opportunity in the data and the tech we have now to do that.
Are there certain nuances industry by industry that you're looking at? I know you've got some deep expertise in consumer and healthcare and pharma and others.
Yeah, I think, again, it's how they all play together. Everyone is talking about trade. It's at least we're feeling a little bit more comfortable now, having moved and adjusted supply chain. But you can't look at these risks alone. I mean, even cyber, it's a geopolitical risk. It's not just a risk to your reputation and brand. You're thinking about nation states and other governments, and so you've got to think about these as broader concerns. And as you think about your supply chain, is there cyber risk as well?
Absolutely. And so on a practical level, for leaders, that is the theme of this dialogue here. What do you think it means for leaders, and in particular, where they should focus and kind of dedicate their time and limited execution capacity?
Yeah, it's great. Well, whatever has gotten you all here today is still very much valuable. You've demonstrated the experience to be in the C-suite. You've got that instinct that has gotten your company where it belongs. You have executed flawlessly. What I would say the leaders of tomorrow are going to need is to really think about how do they continually switch up their playbooks. It's not just about running the plays. I mean, that's a piece of it. But how do you continue to evolve what you're doing and look around corners and think creatively? Make sure that you're asking yourself, is there something different that we should be doing? Challenging yourself. I'm actually most worried about the companies that are really steady. I think we all know an American company or a company globally that isn't what it once was. And I think those that are steady, that aren't used to dealing with disruption or don't see it coming, are the companies that we've got to worry about.
And is that changing culture? How do you get kind of underneath the hood?
I think it's definitely changing culture. I think it can be easy when things go well to keep them going steady. And I think it is taking a risk to shake things up and ask the questions that maybe no one's asking. But I do think that is what's going to keep you on your toes. And I've heard a lot of great stories again this week of leaders that have done that. And so it's proven that it's working, but I don't think enough leaders are doing that today.
Just to close out, what is the one piece of advice that you wish the folks who are sitting across from you would really heed?
I would say, I think we've been paralyzed for a long time about the amount of data and information that is out there, and that hasn't changed, it's only grown. But with the advanced technology we have with AI, you can synthesize that data and make decisions so much more quickly. We've got a lot in our hands that we could be using to be more confident about our decisions as leaders.
Well, what a time to be a risk and regulatory specialist. Michelle, thank you so much for your time.
Thank you.
Please welcome Brian Kreiter of Braidwell, Tom Polan of Becton Dickinson and Company, and Yinka Adegoke of Semafor.
Thank you. Good afternoon, everyone. Thank you for being here. I'm excited about this conversation because I'm going to learn a lot about connected care and healthcare. And I wanted to start off by just thinking about hype versus reality. A lot of these conversations, a lot of what I read is about how everything's going to be connected. There's going to be, AI is going to do this, robotics is going to do that. I mean, I'd really like to hear, I'll start with you, Tom. What do you think is we're on the cusp of in terms of the way healthcare is going to change?
Yeah. So the hype is real, for sure. Just a little bit about us. So we're Becton Dickinson. We're the largest manufacturer of medical devices in the world. We make 35 billion medical devices a year. We serve 190 countries around the world. We have actually nearly 4 million smart connected devices already in hospitals, bringing that to life. Yes. And I think what's really exciting is, I always say, there's never been a better time in the history of the planet where you can get better faster. Right? Whether or not it's the use of AI or material science or gene therapy or cell therapy, the cutting edge technologies that are in healthcare today, it's an amazing time to be in the industry. For us, the reality is every country in the world is struggling with healthcare costs. That's and true. Everyone needs, is focused on obviously quality of life and outcomes. And there's not a lot of more money to go into the system. And so you've got to do things differently. And I'm sure we'll get into it through the discussions, but AI truly has opportunities to change that curve. Robotics has the opportunity to change that curve. The connectivity and the use of multiple technologies stacked together and architected, by software and AI has the opportunity to change that curve. And so, again, we couldn't be more excited about that. We'll talk about it.
Yeah, and the same question to you, Brian. You're coming from a slightly different perspective, but it's the same idea, right? Like, you're having to make these bets on companies that you think are going to be well adapted to these changes. What do you see that works right now?
So we have an investment firm called Braidwell. We invest in medicines, medical devices, medical diagnostics, really across the full spectrum of disease and technology, and really focus on how do we build systems and technologies where we can really watch everything and try and find the most exciting and impactful things. Also find places where there are gaps. I think, to your question, I agree with Tom's perspective. We need hype. We need massive change.
Oh, that's interesting.
There are few. It's tragic how poorly healthcare works for most people in this world. And there's few things that are designed in a less sort of consumer patient-centric way. You just think about what most people's experience is, from what it is to just get primary care to, should you need advanced care in a hospital setting, to just what the path of getting a prescription is. One person writes you a prescription, you go somewhere else, they hand you a slip, somebody else tells you if you can buy it. And that's in a developed world setting. And so what we see is this opportunity and just this need to really fully rethink things from the patient back and starting there. And I think there's a number of great companies, including this one, that's doing that. Ultimately, I think we're at this moment in the world where I'm sure we've been talking all week long about there's a lot of questions about who to trust and what to trust. And really, at some level, you're a journalist, like this question of who tells our story. And one of the most exciting things, I think, is there's this change going on in who gets to tell our health story. And more you're seeing individuals being able to tell their own health story, where their phone or their computer is becoming their first line, or you're having the type of diagnostic capability that your story in real time, in more accuracy, can be shared. And that starting point becomes the starting point for not just a care setting, but for what are the drugs that already exist that can be repurposed, what are the drugs that need to be developed. But it all really comes back to what that accuracy and that agency is of the initial patient.
Yeah, I mean, this whole entire conversation is a data question, right? Like how much information I have about myself now through my phone, through my smartwatch and what have you. Tom, how is that? You already talked about the 4 million connected devices, but just give us a sense of how much you're perhaps transforming your business to bring that perhaps to the 35 billion that you talked about.
Yeah, we're really focused on using AI in 3 areas. One is to improve productivity of healthcare. One is to help clinicians make better informed decisions to improve outcomes. And the third is, where it's appropriate and safe, is to actually autonomously deliver care. And so, an example of productivity, we have about a $750 million pharmacy robotics business. So if you think about e-commerce platforms where you can get drugs delivered to your home within a few hours rather than go pick them up at a pharmacy, they don't have pharmacists in e-commerce warehouses counting pills and putting them in amber vials. I guarantee you that. Those are our robots, right? There's robots fully automate that. No pharmacist should go to school to count and put things in an amber vial, pills. We've all seen it happen behind the CVS or the Walgreens. So that's all being automated. It's enabling, right? That's a productivity savings as an example. Productivity of making sure the right medications are available for the nurses up on the floor when they need them, so they're not spending their time searching for them. We have technologies that enable that. Those are some examples there. You think about better clinical decisions. We have multiple products that are AI products approved by the FDA with AI algorithms. Example is if someone were to go get a heart valve replacement, or if you were to get a organ transplant, one of the things that happens to your body is you lose the ability to autonomously regulate your blood pressure often, and hemodynamic stability is really important, right? You can't do kidney perfusion or brain oxygenation, et cetera, without just the right blood pressure, and a lot of negative things happen. So, and actually, each person has a different score. When you lose the ability to regulate blood pressure to your brain and make it keep it oxygenated, is actually different than yours, and it's different than yours. And so we use AI to actually predict that and tell the surgeon when they're on the operating, like this, you're going to have a problem when it reaches this level. Never let that happen. Babies, actually, premature babies never even have that ability to start with. So you really want to understand those scores to help prevent brain damage in premature babies. That's a great use of AI. Again, that's helping give clinical information that would be otherwise invisible. No one would ever know that type of information if it wasn't for our algorithms and AI. And that's just one example. We have many other applications that are there. A third example of when do we see it appropriate to autonomously deliver care. So something that we have actively in development that we've shared. We have all of the We know every medication that people are getting when they're in a hospital typically. It's our software that is managing the inventory, it's doing the compounding, it's actually dispensing the medications on the floor. We have 60% of all hospitals in America use our smart pumps that are infusing. That's going into your electronic medical record. We know all that data. We recently bought a company very strategically that does all the monitoring. So the sensors that you have, whether or not measuring brain waves or measuring pulse by pulse, blood pressure with a catheter in your vein or minimally invasive, we know all that data. So we're taking those tech stacks, and again, a nurse could be going in, changing your medication flow rate to try to keep you perfect, and they go in when it alarms and you go out of line, or they go in when they change the medication bag. But in the meanwhile, you're swinging all over the place. That doesn't need to happen, right? We can connect those tech stacks, the monitors, the pumps, the drugs that you're getting, and just do micro adjustments all the time to keep you in an optimal state, rather than nurses having to come back in and do that. So that's an example of autonomously delivering care. Right. And we're just getting started, right? Those things are coming to market in the next near term.
Brian, what's the barrier to, this is one company, right? And you can see this happening across so many businesses that, affects the entire industry. But what is the biggest barrier that you see and that you're obviously trying to get around when you're thinking about investments or, where you're, companies that operate that you invest in? What do you see that we really need to overcome to, sort of get to a place where this is just like standard?
Yeah, so I think there's barriers of different types and different system barriers, different product barriers. I think sometimes barriers are hiding in plain sight. So one of the topics that we are fascinated by is the topic of drug persistence. So we have, as a scientific community, as an industry, globally, produced some tremendous medicines. We now have medicines, you've seen what's happened over the last several years with the GLP-1s. There are medicines that should have dramatic impact on folks' cardiometabolic health. We now can have medicines that should be able to take down someone's risk of having an adverse cardiovascular event dramatically, and these are around. And the interesting thing is, we know for cost reasons, for access reasons, there's lots of sort of initial barriers. But one of the things that the data shows is even when people get on these medicines, they don't stay on them. And that might be also for those same cost reasons or access, but also humans we know. All of us in this room, we know we're not great at habits. So one of the challenges hiding in plain sight for us that we're super interested in is how do you just treat chronic disease by making it easier for folks to take medicines, by having medicines that last longer, for having things that have an easier delivery strategy. And so I think even before you get into can AI find and engineer or discover new biology, there's tremendous amount of change and possibility just from greater awareness that will happen from some product development. And so we love that idea. On the other side, the AI world is impacting the space of medicine development dramatically and massively at this moment. If we were here a year ago, I think it might be, we'd be at a very different place, and I think a year from now we'll be at a different place. One of the things that we do as part of our overall strategies, we try to look for missing medicines. What are medicines that should exist but don't? And particularly where are medicines where maybe the biology is already understood, but there's engineering work that needs to be done to improve those medicines to make them safe enough or effective enough or predictable enough or to be able to use across indications. And what we are finding with a number of companies we've partnered with is the ability now to use AI, AI as it exists today, not what it even might be, but use AI to tackle very specific selected engineering challenges to quickly make medicines at a lower cost and at a higher speed than we've ever had before. We are going to have, as a community, in a short number of years, a dramatic expansion of the amount of solutions available to us.
The opportunity sounds, honestly, frankly, amazing. Like, really impressive. But as I think about AI, particularly in healthcare delivery, coming back to you, Tom, and just some of the sort of the way you described things that you're already doing and where this might go. What are the risks and who's responsible if something goes wrong, right?
Yeah.
Like, how are you thinking about that, managing that risk, and if AI gets it wrong and delivers the wrong drug to the wrong place, or whatever the situation is.
We're a 128-year-old company. We're obviously extremely focused on making sure that everything we do is safe and appropriate. So we would go through the normal, clinical trial process, et cetera. We spend a lot of ramped up on the cybersecurity side as well. You need to make sure that those tech stacks are secure. Obviously, AI, the cloud is really critical to that. We actually just launched. We have an AI platform that all BD smart devices feed into. We call it BD on Kata. We just actually launched it in Europe in a European appropriate, actually the Amazon cloud that's in Europe. Obviously, there's different sovereign right requirements to bring AI to life around the world, which I think is really important, is to get the quality of care up. On a global basis, that's something we're spending time on. Working closely with regulators, we've served on a number of FDA committees around AI and around cybersecurity for AI-related and smart devices. I think the FDA, I can only say very positive things on the FDA. They've really been leaning in, looking to bring them to market faster. We do a top-to-top with them twice a year. I was actually just talking about devices we were bringing outside the U.S., and I got pulled over by the head saying, how can we bring those to the U.S. first? Like there's real interest to.
That's really interesting. When you're doing it outside, if you're I'm thinking about so much in tech, gets regulated much more strictly, particularly in the EU.
EU has really slowed down, unfortunately, the innovation cycle for medical devices with over-regulation. And I think the U.S. is leaning in, seeking to bring new innovations to market. I think the bigger challenge for AI in the U.S. that has to get worked through is more the CMS reimbursement angle, because most AI technologies aren't reimbursed. So especially if you're having, AI read your X-ray or your mammography, how's that getting reimbursed? And because today, I hear so many stories from colleagues I've heard probably 2 in the last 2 months of, an X-ray being missed. A friend runs it through AI, it finds something, and then they say, actually, it is right there. It's amazing, the technology, where it's going. Yeah. So I think the regulators are leaning, particularly in the U.S., I think reimbursement and how it gets funded is important. Yeah. And that one hasn't been figured out yet.
Brian, how are you thinking about regulatory risk? Well, as you're making investments or...
We spend time thinking about that. I'd say personally, I'm more concerned about competitiveness. I think, the U.S. Infrastructure for science in terms of not just through academia, but through what's happened commercially, the regulatory environment that's existed is such a gem. And the world is changing fast. If you look at drug development in China today versus where it was just a few years ago, what's being produced, how quickly it's being produced, where U.S. companies are getting their feedstock innovation, I think we have real work to do to ensure that we're continue to be on the front edge.
This is about regulators moving quicker, like what Tom was saying?
I think it's about, if you take a regulatory strategy broadly, it's about creating an environment that is ripe for innovation. And so when you have a world where increasingly we're going to have robotic wet labs, where robots can run the types of, can create and test material in a way that can be built very quickly and run a huge amount of experimentation, that can be done anywhere. And so if we want to make sure that continues to be done here and that this is a center of innovation and that we can be an exporter, not just commercially, but of the type of goodwill that creating health in the world creates, I think we need to make sure we continue to invest and create an ecosystem around that, which includes also understanding the way those tools are.
Right. And just to follow up on that, because we're coming to the close, where's the smart money going for you? Just very quickly, if you're talking in broad terms, where's the smart money going in this space?
For us, we spend about $1 billion a year in R&D. We're investing in 3 what we see as irreversible trends reshaping the future of healthcare. The first of that is smart connected care and the use of AI, robotics, informatics to transform the cost and quality of care. Second is we're investing behind technologies that are enabling care to move into newer care settings, including into the home, ambulatory surgery centers, et cetera. Lower cost settings, more convenient centers than hospitals. And the third area that we invest in heavily is medical technologies that are improving outcomes for patients with chronic disease. Okay. And so those are the areas we see.
I could spend a lot of time talking about that, but I love that list. I think what's happening in the diagnostic space is incredible. We're seeing companies deliver blood-based diagnostics, places where folks aren't going to get knowledge of a cancer or some other problem they have, and now they will. That'll make it easier, and we're seeing that roll out very quickly. We love that from a human impact perspective. We like things they're starting to impact the most significant chronic diseases in the world. Cardiovascular, metabolic, neurodegenerative disease. These are the big longevity crises. When we think of that word, it's really about avoiding those big diseases, and so we love the innovation that's making it easier for folks to get preventative care and to get ahead of that. And then we see, a tremendous amount of money has come into this space over the last several years, and we are starting to see the product of that. And there's been, we are going to see new targets, we're going to see new mechanisms, and so I think there's a lot to be really optimistic about.
A lot to be optimistic about, plenty of AI. Thank you both very much for your time. Thank you.
Please welcome Aliko Dangote of Dangote Industries and Justin B. Smith of Semafor.
Well, this conversation is definitely one of the most special conversations we're going to have. You can see the cell phones going up.
I can see that, yes.
The great DJ Aliko Dangote. No, I want to welcome Aliko Dangote. For those of you who don't know him, he is Africa's and probably the Global South's most consequential business leader on so many levels. And he's been engaged, especially in the last couple of years, in some incredibly courageous investment work in the energy industry. He's just built the largest petrochemical refinery in Africa. And of course, as we face this energy crisis right now, is in the middle of so much. So welcome, Aliko. Thank you so much for coming. I've been asking you for 3 years to come, and you finally came.
Well, I'm finally here.
Thank you.
It's good to be here.
All right. Tell us the story of how you had the idea, because he already had the largest company in Africa, and then decided what many people at the time thought was crazy, was to build Africa's biggest refinery, which, by the way, I think can fuel all the petro for the entire continent if it's required. But tell us the story of that.
Well, thank you, Justin. We decided to build. Long story. We bought the old refineries of the government. Then another government came in, they reversed. Then we went and said, okay, we want to go and build 300,000 barrels per day refinery. And so we started work. I remember I went to see Dr. Fale, who was the Minister of Energy then of Saudi Arabia. He invited me over. Was during fasting, to break the fasting with him. So he said, well, Aliko, I heard that you want to build a refinery. I said, yes. He said, but refineries are only built by multinationals and sovereign governments. I say, well, yes. So, we started the conversation. I said, but hold on, Your Excellency, I'm not actually looking for advice because I'm already in. I've started. So he said, oh, really? I said, yes. So, okay, wow. Okay, I wish you good luck. How big? I said, 650,000. He said, but how? There's no 650,000. I said, no.
650,000 barrels a day.
650,000 barrels a day. The largest line that was actually ever built was by Saudi Aramco, which is 460,000 barrels. One single train. They come in trains. So single line, we said now we are going to do 650, and we went to a couple of these EPC contractors. EPC means engineering, procurement, and construction contractors. And, almost all of them really turn us down. No, Nigeria is risky, blah, blah. So, okay, we now decided to create our own company, construction company, and we did everything, A to Z.
How long did it take?
It took us
8 years?
More than 8 years. It took us about 8-9 years. But 8-9 years of various problems.
Yeah.
We had about, the real construction started 2018, because we had challenges with various government about land. We had to shift the land to another state. And then after that, we now face the issue of the land itself. So we had to debush, because it was like a mangrove, trees all over. And we were able to, it took us 8-9 months to remove that. Then the climate change, we have to now pump 65 million tons of sand to take it off by 1.5 meters.
So let me just move right into the news of the day, which is obviously with the Straits of Hormuz closed, we are undergoing a massive global sort of energy shock. You're right in the middle of it. You're a player in the middle of it. You have a different perspective because you're a Nigerian based in Africa. Obviously, you're closer to the global south and the African countries. How do you see the situation right now, and how do you see it unfolding?
Well, the situation now is a very tough one. You are right, we are in the middle of it. The luck is that we are now at full capacity of, the petrochemical, which is polypropylene. The refinery were major suppliers of aviation to UK and also to, North America. We do export gasoline to the US also.
But what are the impacts already on because a lot of the impacts of the closing of the straits are sort of slightly delayed. Obviously, the price of oil has gone up, but it comes down based on a Trump tweet, and then it goes back up. What is actually going?
Well, that's why really.
What is actually happening on the ground?
It is really very, very tough period, because you can really lose a lot of money. Even though the good thing about our own business is that now, because of all this crisis, the cost of crude and the cost of petroleum products has actually been separated this time around, because the cracks, which means the profitability in terms of processing the crude into products, in aviation fuel. If you look at it today, if we continue like this, majority of African airlines won't be able to survive, especially the domestic ones.
How long until they go bankrupt?
Well, I was just saying something like that about the Nigerian business. Just as I was waiting to come in here, I realized that, look, they have even issued a statement yesterday that they are not going to operate from the 20th, because they won't be able to, survive. So this thing has actually...
This is all African airlines, or just some, or...?
No, this is the one of Lagos, Nigeria.
Oh, Nigerian, okay.
But other ones, I'm sure they will...
And what are the other impacts in Africa right now? What about fertilizer? What about the...
Well, the impact is very huge, especially when you look at now fertilizer. This is something that 2 months ago, we were selling fertilizer at about average of $400. Today, it's $850.
Jesus, wow. And what's the impact on Africans?
The impact is huge, because it means that this season, this farming season, the governments, they have to actually give subsidies. If they don't give subsidies, the farmers will not be able to afford, fertilizer. What we did, like in Nigeria, really, we didn't increase the price. We kept the price. When we realized that it got up to about $550, $580, we kept the price at that level.
What's the best case scenario? What's the worst case scenario?
Well, the best case scenario is now to come to an agreement between U.S. and Iran. And even that one now, because of a lot of backlog in the pipeline, it's a supply chain issue. And it's going to take some time. Maybe it will take another 2-3 months before we go back to normal. Even now, you are right. Between morning and night, you see the oil moving up and down $10. Yeah. I've never seen it like that. Yeah. Never. So with that, if you are not lucky, you lose your shirt. So the issue is that we are just lucky that the price is a bit high in terms of the product. If not, because we've spent so much money hedging.
Yeah. So let me move quickly to China's role in Africa. In America, you read a lot about, in the American press, which is probably quite biased in many ways, that the Chinese are, are sort of taking over Africa, but not necessarily, building, the solid infrastructure that's required, potentially not striking very fair deals. What's your perception of the Chinese presence in Africa, and is it something that America should be concerned about?
Well, you see, the case between Africa and China is the case of where everybody sort of abandon you, and somebody is coming to you to say, okay, fine, you know what, let us partner. We want to offer you X, Y, Z. We get credit lines, from China. And in fairness, they deliver on time. And if you know what you are doing or what you are buying, the Chinese will also deliver quality. You see, a lot of people, actually, they have not maybe visited China. I'm sure half of this all have never ever been to China. But when you go to China, the quality of what they are producing is amazing. I mean, even today now, you go and look at BYD. Yes, I mean, BYD, I don't want to make a judgment, but BYD and Tesla, that's a big difference. I don't want to say which one is better because God, I don't want to be sued.
I'm not sure we want to upset Elon Musk.
No, I'm not saying anything. So when you look at it, right, people are really underrating, China. And some of the things, if I now come to US and I want to buy 10,000 trucks, it might take me a year and a half or so before maybe Mack or so can deliver those trucks. But when we decided as a company, even though we are producing gas oil, which is diesel, we want to move from diesel, as if we knew this crisis was going to come. So we plan on moving to CNG because, we use a lot of gas and we have CNG infrastructure. We built infrastructure. In China, in 7 months, they supplied us with 10,250 trucks.
So it
is only in China you can get this kind of scale.
But the Chinese investment activity, infrastructure in Africa, is quality as well?
The quality is very good. But let me tell you, the only thing that I have as a challenge, also as an African, is that, yes, most of what they are doing with government to government, that's why there is an issue. Yeah. And the issue of what America keeps raising is that, look, there's no competitive bidding. Because they will do the design, they will now come with the package, okay, we're going to give you this, and it will take, maybe you can pay over a period of 5 years or 6 years. But because majority of people in government, with respect to them, they don't have the capacity that we have in the private sector, where we know about cost, we'll invite 10 companies to come and bid, we'll negotiate, squeeze as much as we can, up to the time that we see that there's no blood coming out.
So what are the implications of China's strong presence for America? And if you were advising America, what would you advise America to do in response?
Well, I think America, they've started now by maybe trying to address the issue by looking at certain of these Development Finance Corporation, DFC. I think that is a start. And it is high time for US to do that, really. For some of the investors in Africa, we are trying to de-risk those risks That is why we are investing heavily, and we are saying that, look, we are looking for also partners. An area where, because, I mean, one of your guys, I don't want to mention his name, asked me that, okay, but what about this resentment that, everything is Dangote? I say, yeah, because Dangote were the ones that actually are investing heavily because we believe in Africa, we believe in the future of Africa, we believe in the prosperity of Africa. But what are we going to do going forward? Now we are trying to say, okay, fine, any African that is interested should come and buy shares. He will get his dividend in dollars.
I once heard an African business leader said, when I think about America and China, my heart wants to go with America, but my head wants to go with China.
I think you're right. Because, you see, okay. Let me give you an example how China, they are able to get the market. During the sanction on, on Chinese goods into the U.S., I went to Semafor, that's the insurance guarantee company, and they said that, yes, we lost about, 10% of market share in U.S. because of the tariff. But overall, our business has grown by 20% other areas. So net, we have made so much money. And I asked Semafor, so how much money have you? They say have given about 1.4 trillion naira in support of their companies to sell goods to Africa.
Last question. What is your argument to American investors? As you say, it's sort of always been a little bit of an empty promise. We're going to come to Africa. What is your argument to American investors to come to Africa in 2026? Why should they?
I think they should. They should come as a partnership. I don't think, even myself, you give me an opportunity today to come to US, I'm not going to come to US on my own. No. I would like to have a local, credible partner and partner with. So in Africa, most of our problems is that we are waiting for foreign investors to come and develop our own land. It's not possible. You can only, that can only happen by we Africans. We must lead, others will join us. Okay, if we don't commit our own funds to develop our continent, nobody will do that for us. So I think it is high time for most of us of African descent or whatever to come and believe that, yes, the future is Africa and we should invest. Of course, you look at which areas, to invest. Once you do that, other people will join you. They will have interest because, like what I said, even myself, in some countries, we are different. We take risk because we know almost everybody. But normally, if you are going to invest, I would advise that you invest with a local person.
And Semafor started in 2 regions, US and Africa.
Yes.
And we'll close on this, that backstage, Aliko said he would be the co-chair of Semafor World Economy Africa.
Yes.
Thank you so much, Aliko Dangote.
Thank you. Thank you.
Thanks, Aliko.
Please welcome C.S. Venkata Krishnan of Barclays and Andrew Edgecliffe-Johnson of Semafor.
Welcome.
Thank you.
Thank you for joining us.
Thank you.
So, you're one of the UK's most important bankers. We're meeting in the US. I wondered if I could start by asking you about possibly your most significant US investment. What have the returns been on the investment in the Barclays Center in Brooklyn?
In the Barclays.
In the Barclays Center, the arena you have in Brooklyn. Is that your best U.S. investment?
I wouldn't call it the best U.S. investment financially. On the other hand, metaphorically, it gives us a great presence in New York. And I'm happy to say Brooklyn is a thriving place in which to have the Barclays Center. But more broadly, what it represents is a commitment Barclays has to sport. And not just men's sport, but women's sport.
Yeah.
And we do it with basketball and the Liberty in Brooklyn, as well as in the English Premier League, where we've been a sponsor for a long time, English women's cricket, and the Women's Soccer League in the UK.
All right. So we'll get on to some more U.S. investments in a moment, I think. But our theme is leadership in uncertain times. You've been leading this bank for 4+ years now, so you know something about this challenge. 5 years, isn't it? 2021. And 2.5 years ago, you began a 3-year turnaround plan. You just announced a second one. But since then, you said, as you said at your last results, the bank's firing on all cylinders. Share price hit a new high just before the conflict broke out in the Middle East. But when you go back to the decisions you made early in this process, what do you think you did as a leader that was most important for getting the bank new momentum?
Yeah. I think it is to try to identify what were the difficult decisions and to make them.
Right.
You can spend too long debating whether something is important, and then once you've identified something is important, you can spend too long debating how you should decide. For Barclays, there were 2 or 3 important things. Number one is, what should the shareholder expect from holding our stock in terms of returns? And we made a commitment then of £10 billion over 3 years. We made a commitment now of greater than 15 over these 3 years, 24 to 20, 26 to 28. The second thing had been, what is Barclays' commitment to its home market, the UK? I think it's really important for major global banks to be strong at home. And to be frank, we had been insufficiently committed to the UK.
Right.
And so we'd made that commitment. We set £30 billion of risk-weighted assets into the UK. The third question, which had been haunting Barclays since the acquisition of Lehman Brothers, was, should you be in investment banking? And if you are in investment banking, would you be good enough at it? And we then set a strategy to keep our risk-weighted assets in the investment bank constant, to increase our returns and to increase our profitability, all of which we've done. So we've got double-digit returns in our investment bank, and we are the largest investment bank outside the top 5 US banks. But in some sectors in fixed income financing, in prime and so on, we are comfortably in the top 5, sometimes in the top 3. Mm-hmm. Barclays is the house that credit built.
Okay. So you set the strategy.
Yeah.
What's been most important for the execution piece of it? I mean, to what extent was there a cultural job to do as well to get the bank to move faster?
So there's a huge cultural job, because coming up with the strategy is one thing, selling it to the internally and externally is another thing.
Yeah.
I was very lucky, we were all very lucky at Barclays, that our shareholders and investors liked what they saw, which made the internal sell job easier.
Okay.
And then once you have that, it's really about discipline. It's about disciplined execution. Keep reminding people if they want to do something new or different, or a challenge is too hard, that they don't have that many options. They've got to stick to delivering what we promise the shareholder.
Okay. So you got to this point, as I say, the share price hit a high just before the Middle East conflict broke out. A lot's happened since your last results. I know you've got earnings coming up again soon, so you won't go into too much detail.
No.
But can you give us at a high level your take on what impact you've seen so far from that crisis and what you expect?
Yeah. So you've been hearing from other people, and you've been hearing from lots of people in Washington, D.C. The markets, and I think investors and CEOs, are really having to balance short-term views with long-term views. In the short term, the equity markets are strong. In the short term, there's a great belief in the continuation of deal activity. We've seen it, and we expect it to continue. In the long term, lurking in the background are 3 things. One is obviously the conflict in the Middle East.
Yeah.
How long does it go on for? What does it do to energy prices? What does it do to energy security? Does it fuel inflation? Does it weaken growth? That's one set of risks. The second set of risks is what's going to happen in private credit. Now, I don't think this is a systemically important problem, but there are liquidity issues, and hopefully they don't lead to credit issues. And then the third thing, which has been there for some time, is what is the true potential and promise of AI? Who will win? Not everybody is going to win. How much corporate adoption will there be, and how much efficiency do we get out of it? And based on that, there will be winners and losers and investments that do well and don't. These are three separate things lurking in the background, separate but could conjoin.
So let's pick up one of those first. The impact of the Middle East crisis. One of the things we heard from the IMF this week is a downgrading of UK growth expectations. You have bet on the UK. It's your home market. You're committed to it. What is going to lift the UK out of its funk? Because it seems as though this country that I come from originally has had some trouble getting traction lately.
Yes, it's your country of origin. It's my country of adoption. But I think the UK has gone through a period since the financial crisis of lower growth than potential. That problem has been exacerbated by Brexit, which has had a genuine cost to GDP and to growth. This current government has recognized it. It's trying to fix it. There are deep-seated issues in the UK related to productivity and the decline in productivity. And that decline in productivity, that has to be repaired to get back to proper growth. So there's been a decline in productivity. There's been a disruption in trading relations with its largest trading partner, Europe. These two things have to be fixed. The good news in the UK is that there's been open, talented immigration in much more than in many other countries, and that has continued to attract skills to what is a dynamic economy and that has very dynamic sectors in technology, in pharma, and in finance, right? Banks are 10% of the UK economy, and London is still a great financial center.
Right. And when you go in to see your regulators in the UK, does this pressure of slow growth change the dynamic at all in the conversation that you might want to have about the regulatory framework that would allow you to lend more and make more money?
Well, I think what we want to do is to help the UK economy grow.
Right.
And capital regimes are important in creating structure and safeguards. You always have to question, and the UK is examining now whether you have the right level of capital or do you have more than you need for financial safety and soundness. I think the regulators understand the importance of banks in providing credit. I think this government absolutely does understand the importance of banks in providing credit. And so, we look forward to working together in this. We will not always agree on every point, but I think the objective is common.
I want to pick up on your private credit point. You don't see a systemic risk here. You personally, Barclays as a bank is reportedly on the hook for exposed to the tune of about $600 million to Market Financial Solutions, the collapsed UK lender. Do you have any update on how much that you're likely to recover?
That we will tell you on April 28th with our earnings, more precise numbers. What I've said publicly is that our estimated losses are much less than that number.
What work have you done inside the bank to understand how that happened?
Yeah. I've been a risk manager for many, many years, a professional risk manager. Risk management is an evergreen process. It's like mowing your lawn. Every now and then you find weeds, and you said, I thought I'd mowed that part of the lawn, but I see a weed there. So you always find something that you learn from these situations. I think client selection has always got to be the most important thing in banking. And the question you ask yourself is, how do you find yourself with a client like this? I wish we had nothing to do with Tricolor or with MFS, the company you've mentioned, but we did. Okay? And what everybody in the bank now understands is they've got to reflect on that and see that we don't have clients like this inside the bank.
I mean, it looks as though there were quite a lot of red flags there, sort of using weird tiny accountants and things like that. Have you put in place any new measures to avoid the next MFS?
Well, you always learn from these things,
yeah.
and you tighten your belts. I think the important thing to understand is when frauds are extremely sophisticated, it's hard to find them out in advance.
Right.
And so what you've got to have is a nose and a discipline that tells you that in parts of the market or types of players who might have a proclivity to do that, either because of a weak business model or imperfect financial controls, to have a nose to sniff it out and stay away.
Yeah. You mentioned the AI the phenomenon driving the bank. What are you investing in right now?
Yeah. So there are three parts of having a successful AI program. One is what I call making the general purpose tools available and adopting them. So we were very early in getting Copilot available to all of our employees. And we've been encouraging adoption individually and in groups. It's not easy. The second thing is to build the infrastructure of data and computing so that you can actually run the programs well on good, clean data. We are putting, we spoke about it at our Investor Day, billions of pounds into that in very targeted and strategic ways. The third, which is probably the most difficult, is to find the high-value use cases that you take a workflow end to end, make it AI-enabled, and uproot what you had before and rely on the new. And we're identifying a few of those in the bank, have identified, and we're working on them. That's really hard.
Because there's resistance when people and processes need to be uprooted.
There's resistance. There's trying to understand the potential of it, and to have the oomph to push through the difficulties in the process.
So you mentioned at the start the sort of this balance between the short term and the long term.
Yeah.
What have you found is most useful in keeping people focused on those long-term goals?
You've got, people have to divide their minds. And the more senior you are, the more you have to have multiple thoughts in your head at all times. So the important thing for senior leadership is to remember why we are doing certain things and to remember the long-term goals and commitments we've had and to keep at it. You also have to build enough flexibility in systems and processes to handle the short term.
Right.
Because we will always have short-term volatility. We'll always have things that come up. And we've got to find the mental capacity, the physical capacity, the operational capacity to deal with it.
Physical capacity is the challenge for me this week, I think. But the mental capacity on this side of the stage is not in doubt. Thank you very much, Venkat.
Andrew, thank you.
Please welcome Finance Minister of Lithuania, Kristupas Vaitiekūnas, and Michelle Fleury of the BBC.
Minister, thank you very much for joining us. Let's start with the big shift we've seen in Europe with Viktor Orban out of power, a leader who blocked Ukraine aid and stalled the 90 billion euro aid package. For leaders like you, who have been working around that obstacle for years, what does this moment feel like? Is there a sense of relief, or what's your feeling?
Okay, thank you for the question. It's a real pleasure to be here. Of course, there is a lot of optimism now all across the Europe and in different levels, in ministries, in embassies, in technical level, and obviously the Orban is gone now. There is a new prime minister, and he will be different in this kind of his attitude to EU, to Ukraine. But the Orban is gone, but he have exposed the weaknesses of EU very, very, very skillfully. And we still have other leaders that are not very positive towards Ukraine. towards the integration of further integration. And now they know how to use the weaknesses of European Union, construction of European Union. So it's optimism, careful optimism, but of course the weaknesses are exposed and now are well known for others to follow the path of Orban.
So can I get you to name names? You said there that there are other countries who...
Well, that's easy to guess, and let that be a secret, open secret.
So just to be clear, with Orban's departure, is there a path to try and get this 90 billion euro aid package through?
I think so. I think we will move forward with this package now. Well, Europe understands that it needs to ensure the finance to Ukraine, for country to remain functional, for military to get, for soldiers to get wages, for soldiers to get bullets, for teachers to get wages. The country must function. The bureaucrats has to work and Europe understands that because if Ukraine stops working, well, then the war is lost. So even if that package wouldn't be accepted, we would find another way. But it's good now we have this 90 billion package moving, and we can ensure the Ukraine financing as soon as possible when the funds are the most needed.
I mean, this session is about leadership. Is the political will there in Europe to deliver?
I think so, but it depends on the context and to deliver what. To deliver funds to Ukraine, yes, it's enough will, but sometimes we think, what do you need to do to win this war? And I think that there is a path for de-escalation, for victory, only if you escalate that. So, for example, we had. In the beginning of the conflict, there was a talks about the no-fly zone over the Ukraine, and it never happened because we didn't want it to escalate it. And that means that Putin is the one who can escalate it and to be one step forward, one step ahead of us. So there is a will to fight, but it's a good question. Is there a will to win this?
And so it seems like you're saying there needs to be more speed, more sense of urgency?
More speed and more willingness.
And is Germany the decisive vote here, both economically but also politically?
It's hard to say. Of course, Germany is the biggest economy of Europe. It's quite successfully now investing in its military, which is it's new for them. So I would say that Germany is the leader of that, but there are 27 countries in Europe and in the European Union, and there is France, Italy, the countries that are almost equally big and important. So it's really difficult sometimes to get the consensus, but I think with Viktor Orban gone, it will be easier now.
Easier, but if you and I are sitting here, say 6 months from now, and it hasn't been delivered, is the verdict then that it's been a failure?
I think it will be delivered, and even if Orban were sitting, the funds would reach Ukraine, I think. The Europe won't let the Ukraine to fall apart, and everybody understands that. But of course, now it's easier, and we can move with this instrument, with 90 billion loan, and maybe in the future to think about using the frozen assets.
Germany's finance minister was speaking a bit earlier today, and he talked about the fact that with the current energy shock, Russia is one of the winners, able to sort of benefit from oil revenues right now in this moment. Do you think that that is boosting the Kremlin's revenues despite the sanctions?
Well, of course it has a positive effect for them because the oil price is almost double from what it was a couple of months ago. Not double, but I'm exaggerating, but it's a lot more expensive. So of course it will add to Putin, not take something out of him. So it's positive for him.
You have argued that Europe should move from freezing Russian assets to actually seizing them. It's a big step, both economically but also legally. Are you prepared to own that risk in public? And do you believe your European partners are ready to take the same risk?
I hope so. Lithuania is always advocating for this move, and there are a lot of countries that support this. But of course, there are countries that are actually holding these assets, and they have different opinion. They want to be safe from the consequences, and this approach failed in the past. But I think and I hope that in the future we can get back to this question and to reach the agreement, because it's very important to ensure that the aggressor must pay for the damage he's done.
Can you tell us who is quietly on your side but maybe doesn't want to say it out loud, just between you and I?
Well, yeah, between you and I, of course, there is Nordic countries, Baltic states. That's even Germany. I think I don't want to make a mistake here, but there are countries that support this instrument.
What does this conversation we're having, the debate we're having right now, what does this tell us about leadership in Europe at this moment in time, with so many geopolitical risks?
Well, Europe faced so many crises in recent years. It was Greece and other southern countries, debt crisis. There have been COVID, the war, now this fuel price. I think the crisis is the best soil for the leaders to emerge.
I was curious, what is one measure in any future sanctions package that you are pushing for that people maybe haven't heard about yet?
Well, if they didn't heard about that, we should prepare it better and to be vocal after it's prepared. But of course, that's the using of frozen assets it's our priority now. I think it would be really good. It would be show that we stand behind this principle that aggressor pays for the damage. I think that's the most important now.
I mean, expand on that point to me. You said, standing behind values. Why is the Ukraine issue so important to you?
Well, Ukraine, I think it's the war in Ukraine. It's the war happening in Ukraine geographically, but it's a war against all of us, against the Western values, about the way we live, about the war against the system where law prevails, not the strength. So yes, it's a war against all of it, and now it's in Ukraine, but it can expand, I think, and Russia, I don't believe they can stop by themselves. They invested too much in it. They cannot explain to the public why they did that, and as long as they're fighting, they can keep that system running. And if they stop, it will be very difficult to explain to people what they've been doing in Ukraine, why there is 1 million Russians gone, why they are so poor, and other questions that they have no answers.
I mean, it really has changed the conversation around national security. Just this week, we've had Donald Trump renewing his attacks on NATO and openly questioning US participation. For a frontline country like Lithuania, how do you lead when your main security guarantor is signaling that they may actually pull out or step back?
Well, this Trump's policy towards NATO, it didn't start yesterday. It started with his first term. And to be honest, after these attacks against NATO, political attacks, countries started to spend more on defense. So that's an interesting part of that. And Lithuania, my country, now spends more than 5% of GDP on that. So we still have this good relations with US, and we value it a lot. And we hope that it will remain that in the future.
And if US forces were to sort of pull back or draw down, where does that leave you?
American forces are crucial in Lithuania, but we also have German troops in Lithuania. We're preparing to accept the brigade of Germany, investing a lot into infrastructure to accept them, to provide the place where they can train, where they can live, where they can keep and repair their equipment. So it's equally important to keep other partners involved in the security of eastern border of Europe as well.
I mean, you mentioned just now that you're spending around 5% of GDP, putting that towards defense. You're one of the smaller economies in Europe. I mean, is there frustration that you're putting your money where your mouth is, and maybe some of your other partners in the European project not so much?
Well, it's what we want. It's not that they put money, but that they shared the view with us. And if they shared the view and understood our standpoint, it would be easier for them to invest into the military, into the defense. So it's the most important is to talk to them, to explain your position, and try to persuade them to change their position.
This is an incredible moment of fragmentation. You've got people like Canada's, voices like Mark Carney arguing that countries shouldn't wait for consensus, they should just act. Is that what we're seeing right now?
Well, of course, it's best if you act after you have a consensus with your partners, and I think it's a good advice for all countries to follow this policy, because one of the strengths of Western countries and US and in Europe is their alliances, their partners. And if all sides understand what somebody is doing, that's what makes us the strongest.
Give me a decision, one decision that would tell the audience, everyone here listening, that Europe got it right, and one decision that would say maybe they got it wrong.
What we got right, yes? Well, of course, it's since our conversation is about the defense and security, the answer will be this. I think it's a right decision we're doing now. We're investing into the defense. We understand the threat. And the wrong decision, what we are doing, it's so late. Because it's all started not in 2022 and not even in 2014 when Crimea was occupied by Russia. It started way back in 2006, I think, when Putin gave his famous speech in Munich. After that, it followed the invasion in Georgia, then Crimea, and then the full-scale invasion to Ukraine. And so it's 20 years already, but when we started spending on defense, we started spending maybe 5 years ago. For 10 or 15 years, even Lithuania and other Baltic states, we've been spending more, closer to 1% than to 5%, despite the fact that we had this neighbor for all the time.
We're almost out of time, so I have one final question, a leadership test, if you like. When we look back at this moment, how will we know if Europe rose to the occasion or if it missed it?
About Europe, yes. Well, it's difficult to say. There are so many different countries in Europe, and they have different view. I think if Europe gets more united, if it learns to project its power, not only to react to crisis, but to project the power to prevent the crisis, then it spent this time properly. If it doesn't, if it's still reacting to the crisis after they happen, I think we didn't learn the lesson.
Minister, thank you so much for your insights, this topic of leadership in clearly very uncertain times.
Thank you very much.
Please welcome Acting Assistant Attorney General Omid Asafi of the U.S. Department of Justice Antitrust Division and Liz Hoffman of Semafor.
Mr. Acting Assistant Attorney General, thank you for coming.
You can just call me Omid.
I appreciate that. You see the clock. We're on a tight clock here. Thank you. Well, thank you for coming. I want to start with some news in the news just yesterday. You settled a monopoly case against Live Nation and Ticketmaster earlier this year. A bunch of states continued that case, and they won yesterday. A jury found the company had illegally monopolized ticket sales. Do you think still that settling was the right thing to do?
Yeah, I think I want to, first of all, thank you for having me here, and please call me Omid, and it's a delight to be here at Semafor. I would say that the states, the remaining states, as I call them, got a fantastic and historic result yesterday, and I congratulate them on it. I think it's a great and historic outcome, period. And then the way that historic outcome becomes a win for consumers is when it translates into enforceable remedies. And so that will be the point where it becomes a win for consumers. And I think we have a fantastic sort of complementary framework at the moment where the remaining states have gotten their finding, and we have our settlement that we're very proud of at DOJ that we think brought really historic relief. And as I said yesterday, this is a win for everyone in America but Live Nation. And what's going to be great is, if as we proceed and go on, our relief is really a backstop for any possible appeal or anything in the future. And that's why I think ultimately it was great to get instant relief now. I think what's good for people to remember is, I was the acting assistant attorney general when I filed the Google search remedies along with a handful of states, or more than a handful of states. And that was a really instructive experience for me because the states and I moderated our position from what the prior administration had done a little bit. And we were very proud of the filing that we had and the proposed findings that we sought, the proposed remedies we sought in our Google search case. And ultimately, that case right now is on appeal. And I'm very confident, and so is the division, that we'll ultimately get the remedies that we're seeking. But there's always a risk on appeal that it'll take years for consumers to see the benefits. And so that's constantly what you have to think about as a law enforcement professional, is making sure you balance between getting the findings you're seeking and making sure that it translates into wins for consumers. And that's where the remedies come in.
And so you're comfortable that the DOJ got what it could and should in the moment, and you are happy to have left whatever, flesh was left on the bone for the states?
Absolutely. I tell my team all the time, I have the most talented staff in the Department of Justice, and I tell them, you got historic relief that had never been gotten in previous administrations. It is going to transform the primary ticketing industry. It's going to result in artist transparency, a reduction in amphitheater control by Live Nation and Ticketmaster. And so I think it's a great outcome that gets instant relief now, pending the relief that the states are seeking. And I am very hopeful that the states will get a great outcome in their remedies proceeding as well. So I think it's very complimentary and a great moment for all Americans, again, except for Live Nation.
That case created some drama inside the Justice Department. I think actually a little bit of perhaps of the reason that you have the job that you did, and that I think it contributed to to your predecessor losing her job, or just some sense that is how that played out. I guess just squarely, there's been a lot of talk about lobbyists having undue influence over the antitrust review process, going over the head of the person in your seat to senior people at DOJ, straight to the White House. Is that happening, and are you okay with that?
Look, I think, as I've said before, lobbyists weren't created in 2025. I think the sense I try to have and the approach I try to take is I'm happy to meet with anyone at any time with my staff and have a productive dialogue. What I always tell companies and their consultants and their lawyers is that you may not always be happy with my decision, but we'll be transparent about what our issues are, what our concerns are, and what we believe you need to do to alleviate those concerns. But we want to project predictability, because I think that's ultimately what's going to give the business community confidence, while also making sure that we can be as aggressive in enforcement as possible. I've been at the department for almost a decade. And I myself, when I was in the White House counsel's office, had multiple meetings with the Department of Justice where we would come in the Mueller probe and ask the Department of Justice what it was looking at, what concerned it, and the general answer we would get back is the facts will take us where they lead us. And I try to make sure that that's never what we're projecting in the Department of Justice. We want to be open and transparent about what our issues are. But as I say to anyone who comes into our conference room, that doesn't entitle you to any outcome. And I'll be very clear about what I think we need in order to have a matter result in a settlement versus going to trial. As I've said, nobody likes to go to trial more than me. And so I love going to trial, but on the other hand, settlements are sometimes the best way to get a result. And my goal, what I try and tell people all the time is the goal at the Justice Department is not to win, it's to seek justice. And justice can be in the form of a litigated verdict, it could be in the form of a settlement, it could be really on a day-by-day basis everything my staff does, whether it's conducting a deposition, filing a complaint, presenting in the grand jury. And so that's ultimately what we have to seek is justice. And a lot goes into that. If you've never, there are very few people who've gotten the honor to walk into a courtroom and say their name and say on behalf of the United States. But what comes with that is an awesome responsibility. And so what I want us to project all the time is that we're being responsible with this profound honor that we have in the Antitrust Division.
Acting AG Todd Blanche was here yesterday and told my colleague that, quote, if the leader of the free world wants us, the DOJ, to focus on something, that's absolutely his right and his duty to do that. Is that how you think about running the Antitrust
Division? It's a fantastic answer.
So we'll just assume you said it back to us. Pivoting gears, there was a story last week that caught my eye that OpenAI, Google, and Anthropic were collaborating on some tech kind of in an effort to blunt China. Competitor collaboration is something that tends to set off alarm bells in antitrust law. How do you think about sort of a national security forward approach to antitrust? Are you going to have to let some companies collaborate or even merge that in a different world would never have passed muster?
Well, I think it's a great question. At an initial level, I don't know that I have to do anything. But what I will say is I've been a part of a national security investigation before. I've spent much time in a SCIF. And what I would say is it's certainly something that we monitor in the AI space where, the reason that Andrew and I at the FTC put out the collaborator guidelines and are looking to receive
this is for the non-technical audience. These are rules that are very strict about what competitors can do and not do, and you're trying to open that up or at least get some input from.
Yes, the guidelines were abruptly withdrawn in December of 2024, and we've put out a request for information because our ultimate goal is if you want to be as aggressive as possible in enforcement, you have to give the rules of the road and give predictability as to what's going to concern you or not. But what it also does is allow us to hear feedback in certain industries that are purposefully opaque, and others that are new, like AI, where you get a new update every single day. Previously, when I was in a different role in the first Trump administration, I was a deputy in the associate's office, and I worked during COVID, and we used the Defense Production Act and other tools because we had to go through a difficult, an emergency scenario where we wanted to be responsive to making sure that the American people's needs were met and were able to get tested for COVID-19 and get vaccines and all that. But on the other hand, we wanted to make sure that everyone understood that the civil rights laws and other laws still applied. And so that's what we're hoping to do in the AI space, where we want to make sure that America is a giant in the AI space globally, but we also want to make sure that people and companies aren't running afoul of information sharing and collaboration. So it's something we talk about every single day, and it's very important to us.
I know you don't deal in hypotheticals, but let me try one anyway. Like if GM and Ford said, look, we are just getting our butts kicked by Chinese EVs, which they appear to be doing, the only way that we think we can make this work is to have a JV that sort of pools our EV ambitions in one place and cuts a bunch of costs. Like that would almost certainly be a problematic deal in a different world. How would you think about something like that?
I mean, the first thing I would do, rather than think about the end stage and say that's completely unacceptable, I think the first thing I would do is have the parties come in and meet with my staff and I. I think first go to my staff, allow my staff and I to have a briefing with each other, but then really just engage with the companies and say, here are our issues. And it's helpful to learn about different industries. It's what makes antitrust such a rewarding profession. But it is helpful to hear from businesses about what they're facing, and if there's creative solutions that's something we should explore, but we need to make sure that our core mission in antitrust is protected. And that's making sure that we're cracking down on unlawful collaborations and promoting competition. And if there are ways to sort of have nuanced new approaches to a new problem, that's always something that we shouldn't be afraid to explore. But on the other hand, the hypothetical you mentioned is a concerning example. So I'd view it skeptically, but be open for discussion, open for white papers, open for hearing about what the competitors, the other people who aren't a part of the JV would think, whether this had ever been done before, and sort of have that engagement, but that it goes into it. I mean, that's why I always try and tell people our job is not to sort of cultivate an image of ourselves as being tough. It's to engage in a sort of a productive, substantive dialogue to see how we can take care of protecting competition, but making sure that the free market is thriving.
And in a situation like that, if the national security community called you and said, look, we know you hate this, but like it's important, the alternative is Chinese EVs on the road sending, images back to Beijing, do you say, of course, like that's my job here?
No, I think I understand the hypothetical and I don't want to fight it, but in reality of how it works is that we're in touch with the intel community and the national security community often. Even on sort of what one might think is a routine antitrust case may result in me going up into a skiff. And so it's a much more productive and engaging dialogue that happens over the course of days, weeks, months, and years where we're exchanging ideas. And I wouldn't view it as we're being steamrolled into a national security outcome. Okay. Because that just isn't how it happens.
There's been some reporting that the DOJ is investigating the NFL, which has a complicated but decades-old antitrust exemption for moving too many games off the broadcast airways and putting them behind streaming in a way that is deemed to be harmful to the consumer and sort of anti-competitive. Any of you can tell us about that?
I can't comment on that, but let me explain why. So it goes back to the responsibility of having the position that I have and being at the Department of Justice generally. When you're seeking justice, it's not just the victim who has certain rights, but there's a sense of fundamental fairness that's owed to witnesses, parties, subjects, targets. And so it would just be irresponsible of me to discuss anything active, pending, or anything like that. I think ultimately what we try to do is have routine work that's done, and it either results in action or doesn't, and it's not appropriate for me to sort of discuss matters like that in the open.
Your colleague at the FCC hasn't been shy about it, I will note. Brendan, I guess, has a different job. You sued New York Presbyterian Hospital.
I did.
Is healthcare a focus? Should we expect more of that?
Yes, I mean, my staff did a wonderful job. They executed a great plan, and we're very excited to be involved in the healthcare space. I think we're sort of in year 2 moving away from, I think, were the previous administration's priorities and sort of, putting an affirmative step on our own. Healthcare, agriculture, housing are really sort of our North Stars. And that's a wonderful case. And I really just praise my staff, and we've gotten great engagement, and we're on alert for ways that we can give returns back to people, especially when healthcare costs are constantly rising. And as I said to my staff when I wrote them an internal email praising what a great job they did when we filed is, in that and in Ohio Health, every single person deals with our healthcare system. It's a sort of unfortunate part of life. But if we can get tangible gains for people, I want to get that as soon as possible. And I don't want to leave that on appeal for years from now. I want to get it now. And so that's something that we're constantly thinking about.
One more, we're seeing commodity prices go up for obvious reasons. And there's been, I think, some investigations around price gouging. But as you look, I mean, you're talking about things that are about to get a lot more expensive. Understanding these are global markets, is there specific behavior from companies that you are looking for right now?
Well, from my criminal angle, as a recovering prosecutor, as I like to say, I always look at, price fixing, bid rigging, and market allocation. I think generally speaking, though, even on the civil side, the red flag I see is with competitors. They're fierce. They're, like I said, they're very sort of proud of their own work, and they're also aggressive against each other. For a lack of a better word, they're very much in a heated competition with each other. And so the red flag for me is when you see collaborations amongst people who normally would never work together. And I have instances on civil cases and on criminal cases where I see company A tell company B, their most hated and heated rival, what I'm proposing to you is a great deal for your company. And that's a red flag to me. And then I also, there's different arrangements that happen where the prices only go up. That's a huge issue. Now, there could be reasons for that. That's what the investigation's about. That's what our presence is in. But that's something we're always looking about.
Is there anything you're seeing in energy and fertilizer right now that concerns you?
I don't want to talk specifically about it in industry.
Okay. Well, we will have to leave it there. We're out of time. Thank you so much.
Thank you for having me.
Thank you for attending today's live journalism, and to our partners PwC and FGS Global. We hope to see you again tomorrow morning starting at 9 a.m. here at the Conrad.